Ladies and gentlemen, you may now be seated. The event will begin shortly. Ibu Bapak hadirin sekalian, dimohon untuk dapat menempati kursi yang telah disediakan karena acara akan segera dimulai. Assalamualaikum warahmatullahi wabarakatuh. May peace be upon us. Shalom, Om Swastiastu, Namo Buddhaya, Salam Kebajikan. Good morning, all distinguished ladies and gentlemen, participants, and guests. Selamat pagi, Rahajang Semang. A very warm greeting to each and every one of you. Welcome to the International Tax Forum 2023, Bridging the Two Pillars and Strengthening the Anti-Avoidance Rules. Good morning once again, ladies and gentlemen. I'm Ernie Zomi, and I'm honored to be your host for this prominent event. I would firstly like to welcome our honorable guest, the Honorable Assistant to the Minister of Finance for Tax Compliance Affairs, Bapak Yon Arsal, the Honorable Assistant to the Minister of Finance for State Revenue Affairs, Ibu Oza Olafia, Head of Center for State Revenue Policy for Fiscal Policy Agency, Ibu Pande Putu Oka Kusuma Wardani, Senior Advisor for Canadian Tax Foundation, Mr. Brian J. Arnold, High-Level Official of Ministry of Finance and all government institutions, distinguished speakers and moderators, and to all respected participants, stakeholders, invitees, strategic partners, ladies and gentlemen. Also, we welcome all participants who join us virtually via live stream on Fiscal Policy Agency YouTube channel, BKF Kemenq. Ladies and gentlemen, now in honoring the land of the country we live in, please rise for the Indonesian National Anthem, Indonesia Raya. Hadirin dimohon berdiri. Tumpah darah You may now be seated. Hadirin dipersilakan duduk kembali. Terima kasih. Thank you. Distinguished guests, ladies and gentlemen, praise to the presence of God Almighty. Because of His blessings in this very precious moment, we are fortunate to gather in this wonderful Bali, the island of God, at this remarkable event, the International Tax Forum 2023. Now, without further ado, we courteously invite Ibu Pande Putu Oka Kusumawardani, Head of Center for State Revenue Policy of Fiscal Policy Agency, to deliver her opening remark. Ladies and gentlemen, please welcome Ibu Pande Putu Oka Kusumawardani.
The Honorable Head of the Fiscal Policy Agency, Mr. Febrio Kacaribu, the Honorable Assistant to the Minister of Finance for Tax Compliance and for State Revenue, distinguished speakers, moderators, ladies and gentlemen, Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera, selamat pagi, Om Swastiastu. We are honored to stand before you today at our first International Tax Forum meeting in Bali, Indonesia. This International Tax Forum is hosted by the Ministry of Finance of the Republic of Indonesia, coordinated by the Fiscal Policy Agency, Ministry of Finance of Indonesia, in collaborations with Directorate General of Taxes and several prominent international organizations, such as OECD, ATO, ADB, FD, Expertise France, Prospera, and GIZ. And it is our great pleasure to host this esteemed gathering of experts, tax officials, taxpayers from various sectors, and other key relevant stakeholders. And this event is intended to continuously contribute to the development of Indonesia's taxation and fiscal policy from time to time. And our first debut this year would focus on the discussions on international income tax policy, particularly towards the preparations of the implementations of Pillar 2, and solicit feedback or insight on its implementations, including from taxpayer perspectives. And furthermore, the first event also aims to disseminate the most recent policies relating to the BEPS 2.0 and tax treaty in Indonesia. Over the next 3 days, we are honored to host a diverse and esteemed group of participants representing of participants various landscape of taxation aspect. Among us, present officials from the Fiscal Policy Agency, Directorate General of Taxes officials, the Indonesian Investment Board, the Coordinating Ministry of Economic Affairs, the Coordinating Ministry of Maritime and Investment Affairs, the Ministry of Finance Training Agency, dedicated tax experts from locals and international organizations, and also prominent representatives from our large taxpayer community. And this event is attended by around 450 registered participants attending in person and joining online. So the presence of these key stakeholders underscores the collaborative spirit of this forum, where government agency and private sector experts come together to address vital issues in taxation and fiscal policy. This International Tax Forum is also a part of this year's tribute to Hari Uang Republik Indonesia. HORI, which falls on the 30th of October each year, is dedicated to commemorating the Ministry of Finance enduring contributions to the development of economy in Indonesia. A time when we not only celebrate our nation's progress, but also continuously synergizes the roles and tasks that still need to be completed in building a better future of Indonesia's economy. So our forum, taking place as part of these celebrations, underscores the importance of addressing fiscal and taxation matters as integral component of our nation's development. Overall, our discussions will consist of four main sessions. In the first session today, the OECD will provide information about the latest development regarding Pillar 2, followed by the sharing perspective from various aspects, including implications for developing countries and how countries navigate the tax dynamics. In a discussions panel, which is a session featuring experts from Canada, Australia, University of Lausanne, and the United Nations. And the second sessions will be conducted in the afternoon, focusing on the discussions of Pillar 2 and implications on Indonesia's tax incentive regimes. And tomorrow, our morning sessions will explore the theme of recent updates on the tax treaties, where we pull together various insights from tax consultant associations, United Nations tax community experts, and discuss on how it connects to the current development of digital economy and BEPS initiatives. And in our final session tomorrow, we will discuss the roles of anti-avoidance rules in strengthening the tax base and to further establish tax fairness worldwide. So we are confident that the discussions and interactions during this inaugural International Tax Forum could lead to innovative solutions and policy recommendations that will benefit not just Indonesia, but the global tax community at large. So let's work together, share our insight, and make the most of our time here. So I wish you all a productive and enlightening International Tax Forum 2023. Thank you. Wassalamualaikum warahmatullahi wabarakatuh. Om Santi 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 Om.
Thank you very much, Ibu Pande Putu Oka Kusumawardani, for your hearty welcome to all of us. Ladies and gentlemen, now we'll continue with an opening remark from the head of Fiscal Policy Agency, Ministry of Finance of the Republic of Indonesia, Bapak Febrio Kacaribu, which will be delivered via a recorded video. Ladies and gentlemen, please welcome Bapak Febrio Kacaribu.
And all participants, good morning, selamat pagi. It is my great honor to welcome you to the International Tax Forum conducted by the Fiscal Policy Agency, Ministry of Finance, Indonesia. We are pleased to have you all joining us in person today and hope that you are enjoying the hospitality of Bali's vibrant culture and traditions during your stay here. This forum comes as the global economy continues to be challenging to manage. On the one hand, we see that global economy continues to recover from the pandemic, and this resilience has been remarkable. And despite unprecedented monetary tightening to combat decades-high inflation, economic activity has slowed but not stalled. However, overall, global growth remains slow and uneven, with widening divergences. Amid global uncertainty, Indonesia is experiencing robust and inclusive growth, with over 5% growth rate for 7 consecutive quarters. Building on this positive momentum, Indonesia has regained its upper middle income country status through a swift and robust economic recovery. Indonesia's short-term economic outlook also remains resilient. Moreover, Indonesia has continued its commitment to achieving sustainable growth and enhancing competitiveness through ongoing structural reforms to transform the economy. Ladies and gentlemen, taxation is essential to our economic growth, generating revenue and a powerful tool for achieving our economic and social goals. One of the main ways taxes contribute to our economic growth is by attracting investment. Government has long used tax incentives to encourage domestic and foreign companies to invest in the country. However, a significant shift is underway at the global stage. The OECD has been leading efforts to reform the international tax framework. We are here today to engage in a dialogue about the future of our tax policies. We must carefully design and implement tax policies to balance revenue needs with broader economic and social goals. One of the most important of this structural reform is taxation reform. This forum aims to support tax policies to accelerate economic transformation, where collaboration, cooperation, and dialogue will shape the future of Indonesia's tax policies. Our deliberation here not only will contribute to the formulation of Indonesia's international tax policy, strategy, and framework, but will also play a crucial role in our implementation of Pillar 2. On this occasion, I would like to emphasize the importance of gathering input from the participants, especially international tax experts, tax consultants, the Association of Tax Consultants, the business community as we embark on this transformative journey. Ladies and gentlemen, the two-pillar solution is an initiative of the OECD G20 Inclusive Framework on base erosion and profit shifting and has been agreed upon by member countries. The consensus-based two-pillar solution plays an important role in ensuring fairness and equity in our tax systems and fortifying the international tax framework in the face of new and changing business models. The effect of global anti-base erosion model rules, GLOBE rules, in Indonesia can primarily be divided into three areas. First, behavioral changes of multinationals in shifting profits. Second, additional top-up tax opportunities. And third, the design of tax incentives schemes. It is critical for us to dive into the discussion on how to design our international tax strategy and framework. The insights gathered from participants during this forum will be very valuable in shaping our implementation of Pillar 2. As we move forward, it is important that we strike a balance between maintaining economic growth and ensuring that multinational corporations contribute their fair share to our nation. Furthermore, the dissemination of information will be critical to the success of any new policy. The complex nature of BEPS 2.0 and tax treaty modifications require clear communication and engagement with all stakeholders. This forum serves as an ideal platform to bridge the communication gap, ensuring that the latest policies are disseminated and understood by all and fostering an environment of mutual understanding. Ladies and gentlemen, finally, I would like to warmly welcome all of our distinguished speakers and all participants as we deliberate over the next few days. I encourage all participants to contribute to the discussions actively, offer valuable insights, and seek common ground on matters of mutual interest. Once again, may this International Tax Forum accumulate as much input as possible to improve and achieve effective and equitable tax policies. Thank you very much.
Thank you, Head of Fiscal Policy Agency, Minister of Finance of the Republic of Indonesia, Bapak Febrio Kacaribu, for your warm welcome and words of encouragement. Ladies and gentlemen, now it is time for us to listen to the keynote speech on Indonesian perspective on digitalization and the two-pillar solutions. The keynote speech will be delivered by the Assistant to the Minister of Finance of the Republic of Indonesia for Tax Compliance Affairs, Bapak Yon Arsal. Therefore, ladies and gentlemen, let's welcome Bapak Yon Arsal.
Assalamualaikum warahmatullahi wabarakatuh. Good morning, selamat pagi for all of us. The Honorable Assistant to the Minister for Finance for the Tax Revenue, Ibu Oza. Distinguished speakers, moderators, and all participants. A very good morning to all of us. It's a great pleasure to be here today at this International Tax Forum 2023 in these beautiful islands of Bali. It's a very good opportunity for all of us today. Ladies and gentlemen, as we are all aware, digitalization has dramatically reshaped the landscape of today's business. The sheer pervasiveness and efficiency of online platforms have allowed business to penetrate borders, scale rapidly, and often leave behind a far more unclear trail of their financial dealings. The immediate implication is that our traditional tax systems, grounded in a brick and mortar world, are grappling to adapt to this new paradigm. As business become borderless and omnipresent, identifying where a sale and truly occurred or where value was genuinely created has become increasingly challenging. The physical presence of a business, a foundation of the traditional tax model, is no longer an adequate threshold in many cases, just like many authority experience. Now, when a company can earn millions from a country without even having a physical office there, it leaves us with a big question mark about how we do effectively and fairly tax them. This is the challenge all the tax authority worldwide face nowadays. In the face of the rapid digitalization, companies, usually multinational enterprises, have adapted and evolved their business model. With all resource and the global reach, it provides them with opportunities to engage in advanced tax planning techniques, leveraging gaps and mismatch in the tax rule across different jurisdictions. Such strategy, while often within the boundaries of individual countries' legal frameworks, can lead to significant reductions in taxable profits, harming the tax revenue of countries where actual economic activity and value creation occur. When multinationals exploit these loopholes, they shift profits away from where the economic activity takes place, depriving countries of essential tax revenue that funds public service and infrastructure. This brings us to the issues of the base erosion and profit shifting, where BEPS refer to the tax planning strategies that exploit and gap and mismatch in the tax rule to make profit disappear for the tax purpose or to shift profit to low or no tax location where there is little or no real activity. The consequences is that taxable profits are increasingly reported in low to no tax jurisdiction rather than in the countries where the actual business activity took place. Such strategies, while often legal, undermine the fairness and integrity of the tax systems, place enormous strain in public trust, and create an uneven playing field, where businesses that operate predominantly within domestic markets are at competitive disadvantage compared to their multinational counterparts. Recognizing these challenges, the OECD introduced a landmark framework to address the tax challenges of digitalization that we are very aware of, the two-pillar solution. In Pillar 1, it seeks the redistribution of the taxing rights over 25% of residual profits of the largest multinational enterprise to market jurisdiction. We call it the Amount A. And to simplify and streamline the application of the arm's length principle for the in-country baseline marketing and distribution activities, or Amount B. Pillar 1 is expected to allocate the tax right on approximately $200 billion in profits to market jurisdiction annually. This is expected to lead to annual global tax revenue gains of between 13 to 36 billion US dollar according to OECD data year 2021. It is quite a very huge and significant amount, especially for many developing countries where the market actually exists. In Pillar 2, actually, the global rules or global minimum tax will ensure the large MNEs pay a minimum level of tax on income arising in each jurisdiction where they operate. Meanwhile, the subject to tax rule will target specific base, eroding payments between connected persons which are subject to low rates of taxation in the resident jurisdiction. This pillar acts as a safety net ensuring a level playing field and mitigating the risk of harmful tax competition between countries. This global minimum tax framework under Pillar 2 is already a reality, with over 50 jurisdictions taking steps for the implementation, and Indonesia is one of the countries. According to a recent analysis by the OECD, the proposed global minimum tax would produce annual global revenue gains of around 220 billion US dollars, or 9% of the global corporate income tax revenues. The latest development, the OECD has launched several important documents this month, namely the Multilateral Convention to implement Amount A of Pillar 1 and the Multilateral Convention to facilitate the implementation of the Pillar 2 subject to tax rule, with the STTR MLI is now open for signature. Ladies and gentlemen, with the current economic uncertainty, Indonesia facing numerous economic challenges, especially in maintaining sustainable fiscal policy to support economic growth and development. Now, as we stand in the new era of international taxation, we also face tax collection challenges due to the economic transition and the trend of shifting to digital-based consumption has increased. On the one hand, digital trading practices have a positive impact on the economy, but at the same time, it may lead to an increase in the shadow economy. With the current tax administration system, there is a risk of reducing the tax base, especially of the VAT and the corporate tax system. We must continue to monitor and analyze the global economic uncertainty as we work to strengthen the fiscal policy 2024, and tax reform will continue to be a key focus to assist us in the addressing challenges arising from the digital-based economy, which has become stronger in the last few years and has the potential to continue in the 2024. While we believe that the two-pillar solution has undoubtedly a monumental step forward, I believe it is not the end of the journey. As we navigate this dynamic landscape, countries must also be proactive in strengthening their domestic anti-avoidance rules. Robust domestic legislation can act as the first line of defense against the base erosion and profit shifting issues. Tax authorities must be equipped with the tools, skill, and resource to monitor, identify, and challenge the aggressive tax planning. Moreover, bilateral tax treaties also need reinforcement. Historically designed to eliminate double taxation and foster economic cooperation, this treaty should be updated to reflect the digital age realities. Addressing treaty abuse, introducing anti-abuse clauses, and aligning treaty provision with the overarching aims to the two pillars will be crucial in building a cohesive, effective, and fair global tax system. Indonesia itself plans to implement the Pillar 2 as stipulated in the Law Number 7 of 2021. We call it the Tax Harmonization Law, and also stipulated in the Government Regulation Number 55, Number 2022. Today in the afternoon, we will take this opportunity as well as the public hearing opportunity also to introduce the new coming, there will be the draft for our Minister of Finance decree this afternoon. The analysis on the impact of the Pillar 2 on the tax incentive are being conducted, and the formulation of the domestic regulation to implement Pillar 2 is still ongoing, which is we are going to inform you today in this afternoon and get some input from all of the participants today, this afternoon. Its introduction in Indonesia required, of course, the careful planning and consulting to ensure the smooth integration into our existing tax system. This forum represents an important step in the journey towards a fair and more transparent tax system. This moment marks a significant milestone in our nation's commitment to fostering a more equitable and globally coordinated approach to taxation. As we embark on this journey, it is essential to emphasize that the implementation of the Pillar 2 in Indonesia will be a collaborative effort. We welcome the active participation of stakeholders from the government, international tax experts, tax consultants, the Association of Tax Consultants, and the business community. Your insights and perspective are invaluable in shaping an effective and the fair tax system in Indonesia. Ladies and gentlemen, in closing, I encourage all of you to, like Pak Febrio mentioned before, to actively participate in all the discussion, share your thoughts, and engage in constructive dialogue. Together, we can create a roadmap for implementation Pillar 2 in Indonesia that support our national interests while contributing to the Global Tax Forum agenda. Thank you very much. Enjoy the forum.
Thank you very much, Assistant to the Minister of Finance of Republic Indonesia for Tax Compliance Affairs, Bapak Yon Arsal. Distinguished guests, ladies and gentlemen, just a brief housekeeping note that the restroom is available at the back of this building. You just exit through the front door and go to the left. And our prayer room is located on the second floor of this building. And also in the case of emergency, please remain calm and follow the safety protocol. Now, as a remembrance, we would like to take photos of everyone here. Thus, I would like to humbly invite you to please stand up and also face the stage and give your best smile. Please stand up. Silakan para hadirin yang terhormat untuk berdiri. Please give your best smile to our photographer here. Silakan, senyum yang paling manis. Astagfirullah. Okay, is everyone ready? On my count. 3, 2, 1. Okay, one more. 3, 2, 1. Okay, thank you so much. You may now be seated. Silahkan duduk kembali. Selanjutnya, satu lagi. And the next one, I would like to humbly invite to the stage our honorable guest sitting on the first row with all the speaker and moderators to on the stage to please come to the stage to the next photo session. Okay, the second photo session. Yeah. I invite you to the first row, the honorable guest sitting on the first row with our moderators and the speaker. Okay. Yeah. Come on the stage to take our second photo session. Silakan Bapak dan Ibu yang moderator dan pembicara hari ini. Okay, thank you so much, honorable guests, speakers, and moderators. You may now be seated. Okay, you may now be seated. Ladies and gentlemen, before we proceed to our next session, please join the coffee break. We will have a 10-minute coffee break for now, and we will return for the next agenda of the ITF 2023. So we invite you to enjoy the break available in the foyer, and we'll see you here in the same room in 10 minutes. Thank you very much.
Cek. Cek. Cek.
Kita hidupin aja semuanya, Pak. Oke. Dua di kanan, dua di kiri.
Welcome back, ladies and gentlemen. Thank you for being with us again today at ITF 2023. Now we'll continue with a keynote speech on the work of the OECD on two-pillar solution from the Director of the Center for Tax Policy and Administration for the OECD, Ms. Manal Corwin, that will be delivered through a video. Ladies and gentlemen, please welcome Ms. Manal Corwin.
Good morning, distinguished guests, ladies and gentlemen. Thank you for inviting me to present some brief opening remarks at this International Tax Forum convened by the Fiscal Policy Agency of the Republic of Indonesia. While I'm very sorry I'm not able to be with you in person in Bali, I am appreciative of the opportunity to join you virtually today to provide an update on recent developments. As I'm sure you'll be aware, the OECD G20 Inclusive Framework on Base Erosion and Profit Shifting has made significant progress on international taxation reform over the last few months. The Inclusive Framework continues to work intensively to deliver on the final elements of the two-pillar package agreed in October of 2021 and carried forth during Indonesia's G20 presidency in 2022 and most recently during the Indian presidency in 2023. Earlier this month, the Inclusive Framework unanimously agreed to release the text of a multilateral convention for Amount A. The text was published on the 11th of October, together with supporting materials, namely an explanatory statement which provides additional clarification of the negotiations' intent, on how the MLC provision is intended, the various provisions of the MLC are intended to apply, as well as a separate document entitled Understanding on the Application of Certainty, which contains further details on how aspects of the Amount A tax certainty framework will operate in practice. The release of this text represents another significant step towards the modernization and stabilization of the international tax system and is another key milestone in the broader BEPS journey. The multilateral convention, supported by its accompanying documents, accomplishes 5 key objectives. First, it outlines the architecture for a coordinated reallocation of taxing rights to market jurisdictions with respect to a share of the profits of the largest and most profitable multinational enterprises operating in those markets, regardless of their physical presence. Second, it ensures relief from double taxation resulting from this reallocation. Third, it provides a mechanism for securing tax certainty for in-scope multinational enterprises through dispute prevention and resolution with respect to not only Amount A, but certain other tax rules. Fourth, it provides for the repeal and curtails the proliferation of digital services taxes, as well as relevant similar measures, thereby preserving stability and certainty in the international tax system going forward. And then finally, it incorporates several design features and adaptations that are intended to address the unique circumstances of developing economies, including, just by way of example, the exclusion of extractive activities, thus shielding developing countries with natural resources from any reallocation of the related taxing rights, lower thresholds for determining source of income that entitles the jurisdiction to allocation of Amount A, a number of design choices as well relating to relieving double taxation that take into account the unique circumstances of developing countries and ensures that the allocation of an Amount A in those jurisdictions is preserved. This text is the result of 4 years of intense work across 143 countries and jurisdictions. Indonesia has played a significant role in these efforts, not only through Indonesia's G20 presidency last year, but also through ongoing contributions at the Inclusive Framework Steering Group and its working bodies. I want to take this opportunity to thank all of the Indonesian delegates for their engagement, commitment, and hard work throughout the process so far. I know it has meant a lot of late nights. At this point, the vast majority of the architecture of Amount A is now agreed, and only a handful of technical issues by a small number of countries and jurisdictions remains. Those jurisdictions continue to be actively and constructively engaged in the process, which is still very much active and focused on opening the MLC for signature as soon as possible. Meanwhile, the other element of Pillar 1, Amount B, is also progressing. This is the work that would streamline the application of the arm's length principle for baseline marketing and distribution activities. These kinds of activities account for a significant portion of transfer pricing disputes, and we know can create particular challenges in developing countries which don't have access to data from independent comparables operating locally. The aim here is to simplify the regular transfer pricing rules to reduce disputes, as well as minimize compliance and administrative costs. For tax administrations, the measure should help focus scarce resources more effectively. As with any simplification, however, there are a lot of factors to take into account. Simplification is not always so simple to achieve, but really important to strive for. With the benefit of many hundreds of pages of comments from business and civil society, the Inclusive Framework is now working on getting that balance right on Amount B. So turning now to Pillar 2, another major milestone for the Inclusive Framework earlier this month was the opening for signature of another multilateral convention to facilitate the implementation of the subject to tax rule, or the STTR. The STTR rule has been a key priority for many developing country members of the Inclusive Framework. The new multilateral instrument would have the effect of amending existing double tax agreements and would unblock source country taxing rights on certain cross-border related party payments, such as interest, royalties, and payments for services, in cases where such payments are not subject to at least a 9% nominal rate of tax in the partner jurisdiction. The scope and certain features incorporated into the STTR rule, such as the markup threshold, mean that it is targeted at payments considered to be at higher risk of being base eroding to jurisdictions. An important feature of the October 2021 agreement by Inclusive Framework members on the STTR is that all members commit to introducing the rule if they subject the covered income to less than a 9% rate of tax and are requested to do so by a developing country Inclusive Framework member. To facilitate the process of implementation, the OECD Secretariat is now working with all members of the Inclusive Framework to determine which double tax agreements may be affected and where developing country members may benefit from its introduction. The OECD will be the depository of the multilateral instrument and will also support governments in the process of its signature and ratification. Finally, on the global minimum tax, the other element of Pillar 2, we know how hard Indonesia and countries around the world are working to evaluate the impact of the minimum tax rules and consider their practical implementation. Right now, approximately 55 countries are moving to implement the global minimum tax. To help countries with the practical implementation of the new rules, on the 11th of October, we released a handbook on implementation of the minimum tax following the request of the Indian G20 presidency. This short handbook provides a high-level guide to the minimum tax rules. One of the main aims of the implementation handbook is to support policymakers in their own consultation processes with stakeholders in the community and with other parts of the government, including legislatures and those outside of the tax sphere, such as bodies responsible for trade and investment. I know that the minimum tax rules are a major focus of this International Tax Forum, and I hope that your discussions over the next few days will be constructive and fruitful. I also want to take this opportunity to reiterate that the OECD Secretariat stands ready to support Indonesia with this work. Please do not hesitate to reach out to Melinda Brown, in particular, a member of my team who is there on the ground and available to assist with these consultations. Once again, thank you for inviting me to say a few words this morning. And I sincerely hope that next time I'll have the pleasure of traveling to beautiful Indonesia and meeting with you in person. In the meantime, I wish you a successful forum. Thank you very much.
Thank you, the Director of the Center for Tax Policy and Administration for the OECD, Ms. Manuela Corwin, for your insightful message. Moving on to our next agenda, we'll continue with today's keynote lecture on Pillar 2 of the OECD Inclusive Framework. Speaking today is Mr. Brian J. Arnold. Mr. Brian J. Arnold is a senior advisor for Canadian Tax Foundation in Toronto, Canada. He is a graduate of Harvard Law School and taught tax law at a Canadian law school for 28 years. He has been a consultant to several governments, the OECD, and the United Nations. He has also been a visiting professor at Harvard Law School, New York University School of Law, and the University of Sydney. He is also the author of several books and articles on tax issues, including the famous International Tax Primer. Brian will be talking on Pillar 2 and developing countries, subject to tax rules, or STTR, and UN recent work on international taxation. Brian joining us online from Canada today. If I may have the Brian on the screen. Hi, Brian. How are you?
Thank you very much. I'm well.
Okay, thank you for your time with us today. Now, Brian, we are eager to hear your thoughts and findings about these topics. But before that, please allow me to remind everyone that we'll have a Q&A session after the lecture, and I'll be moderating that Q&A session. At the end of the lecture, everyone is invited to submit questions, so we encourage you to take the chance while we have Mr. Brian G. Arnold live with us all the way from Canada. Now, without further ado, I would like to give the stage to Brian. Ladies and gentlemen, please give a warm welcome to Mr. Brian J. Arnold.
And can we have my slides up on the screen, please? Wonderful. And maybe we'll have the next slide right away. Well, thank you very much for that kind and generous introduction. I'm pleased and honored to have the opportunity to talk to you this morning. And obviously, I regret not being with you in person on the beautiful island paradise of Bali. And I will let you know that it is cold, wet, and rainy here in Canada, where I am. And indeed, we had our first frost this morning. And when we start to have frost, the snow and the ice it follows shortly thereafter. What I'd like to do today is to step back from the technical details of Pillar 2 and provide you with my very personal assessment of where Pillar 2 fits in terms of the context of the fundamental features of our international tax system. And by the fundamental features, what I mean is the basic allocation of taxing rights between residents and source countries. Now, my remarks obviously must be taken as preliminary and broad brush, because Pillar 2, while it looks like it's going to become a reality when we look at what has happened with countries around the world moving quite swiftly to adopt Pillar 2, we won't really know until 5 years, maybe even 10 years, how Pillar 2 actually operates in practice. So all I want to do this morning is basically to try and stimulate your thinking about the place of Pillar 2 and its role in our international tax system. My remarks are going to be controversial because I think that's the best way to stimulate your thinking. so that you don't just accept what the OECD tells you or what the IMF tells you or indeed what Brian Arnold tells you. So here are the things that I'm going to talk about briefly this morning. A little bit of history, just to put the Pillar 2 in some context. I'm going to say a few things generally about Pillar 2, a little more detail about the subject to tax rule, because we now have, just recently, some more details about the subject to tax rule, and I think it's rather revealing. If I have time, and I suspect that I may not, I'll say something about what's been going on at the United Nations. But I know you have Carlos Prato there with you. Carlos is a longtime member of the UN committee, and he is much better acquainted with what's going on at the UN than I am. So can I have the next slide, please? So we're all familiar with the original allocation of tax revenues between source and revenue countries that was developed over 100 years ago in the work of the United domestic laws in their bilateral treaties. I do need to mention to you that developing countries were not involved in that work. 1980, the first UN model treaty was adopted. And that UN model treaty, in my view, simply served to reinforce the allocation of taxing rights between residents and source countries that was adopted in the OECD model. Indeed, there were a few things that were different. The UN model treaty allowed source countries to tax royalties, right? So there were some differences, but in general, right, the provisions of the UN model treaty in 1980 were very, very similar to the provisions of the OECD model with respect to the allocation of taxing rights. The past 50 years, I think, has shown that the OECD and developed countries have tried to defend that status quo in terms of the allocation of taxing rights, and resisted efforts by developing countries to reform that system. Next slides, please. So what was this allocation of taxing rights that the OECD and developed countries were so eager to protect? Well, it of course involved sharing the taxing rights between source and residence countries on various items of income. And in many cases, what that allocation involved was giving limited taxing rights to source countries. So that applies to, for example, dividends and interest. Source countries can tax those, but the rate of tax is limited. It can tax on a withholding tax basis, flat rate on the gross amount of the payment. Okay? Same thing with respect to business profits. Source country could tax, but a source country tax could only be levied if the resident of the other country carried on business through a permanent establishment or a fixed base, a rather high threshold for source country tax. No limit on the amount of tax, the tax rate on the business profits, right? But the amount of income was limited to the profits attributable to the PE. The residence country, no limits on the residence country's ability to tax. But the residence country had an obligation to relieve double taxation by crediting or exempting the income earned in the source country. So in effect, what the allocation of taxing rights was that the source country got the first right to tax, but that right was limited. And the residence country had an unlimited secondary right to tax and an obligation to eliminate double taxation. Next slide, please. I should mention there that one of the effects of that was that the source country didn't have to tax the income, so that if the source country chose not to tax the income, chose, for example, to provide tax incentives, because the residence country had a secondary right to tax, that effectively nullified the source country's tax incentives. That's the tax-sparing problem that raised its head quite quickly during the last part of the previous century. And of course, one of the ways to avoid that tax-sparing problem was for the investor to set up a domestic corporation in the source country to earn the income. Right? Next slide, please. Oh, sorry, can you, I spoke too quickly. Can you go back, can you just go back one for me? Thank you. So, when I look at the provisions of the OECD Model Treaty, I detect a clear bias in favor of residence countries. Same bias, I think, was present in the 1980 UN Model Treaty. And that's changed with the addition of provisions like Article 12A and 12B in the UN Model Treaty. But we all know that developed countries will not agree to those articles in their actual bilateral treaties. So it's changed on paper, but it hasn't changed the allocation of taxing rights in practice. Now, I was searching around for something I could show you to illustrate and prove to you that there is this bias in the OECD Model Treaty. And so now if I could go to the next slide, please. So what I basically did was go through the distributive articles of the OECD Model Treaty, looking to see which provisions had shared taxing rights, both, as I just talked about, source country getting the right to tax, the first right to tax, but that right is limited, residence country getting the secondary taxing right with an obligation to relieve double tax. And then I went looking for what are the provisions that give exclusive taxing rights to residence countries. The source country simply can't tax. And you can see on this slide here in that right-hand column that there are a number of pretty significant provisions where residence countries get exclusive taxing rights. And they include, for example, business profits that we would normally characterize as shared taxing rights. But if there's no PE in the source country, then the residence country gets to tax all the business profits derived from that country. Right? The source country gets to tax nothing. That's exclusive taxing rights. The shared taxing rights only arise where there's a PE in the source country. So you can see there, shipping and air transportation, exclusively to the residence country. Article 12, royalties, exclusively to the residence country. Capital gains, other than the ones that are listed in 13.1 to 4, exclusively to the residence country. Article 15, employment income, unless the employee is employed by a non-resident employer or an employer with a PE in the source country, or the employee stays in the source country for more than 183 days, exclusive taxing rights over the employment income to the residence country. And Article 21, any other income, exclusive taxing rights to the residence country. Now, ask yourself, where does the source country get exclusive taxing rights? And the answer is in one situation. Employees employed in government service under Article 19.1. Now that to me is pretty convincing evidence of the bias in the OECD model treaty and the UN model for in favor of residence countries. If there was a justification back in the 1960s, 70s, and 80s for exclusive taxing rights to residence countries, and I doubt that there was, but if there was, I don't think that justification exists any longer. The residence country is not got better access to information, better access to enforcement tools in order to collect the tax. There's simply, in my view, no justification for this disproportionate allocation of taxing rights to residence countries. And of course, did I mention that developing countries were not involved in this allocation of taxing rights? Next slide, please. And of course, the next big feature of the allocation of taxing rights, tax revenues between residents and source countries is the separate entity principle and the arm's length principle. Basically, we divvy up the profits of a multinational group of companies on the basis of the fictional concept that they deal with one another at arm's length. And of course, that with the existence of tax havens makes it rather easy for multinational enterprises to avoid tax by profit shifting and base erosion. And I probably don't need to mention to you that developing countries were not involved in developing transfer pricing rules and the arm's length principle for the purpose of divvying up the profits of a multinational enterprise. So what happened over the years? Well, a lot of rather unsuccessful unilateral efforts, some bilateral efforts to combat cross-border tax avoidance. The OECD made a valiant effort to start this in 1998 with the harmful tax competition project. That project failed, but it wasn't a complete failure because of the stars aligned for the OECD, and it morphed into an exchange of information project, ultimately led to the elimination of bank secrecy and a much better world. But that harmful tax competition project was a valuable learning exercise for the OECD. It learned that it needed to involve more countries in its work. And you could see that, next slide, please. You could see that with BEPS 1.0 and BEPS 2.0, because over a decade after the harmful tax competition, the OECD launched BEPS, the first BEPS project, enlisting the G20's help. And then at the end of that program, when it moved into its implementation phase, the OECD in 2016 created the inclusive framework with now over 140 countries. And of course, as the OECD likes to tell us, 140 countries participating on an equal footing. And an equal footing as long as they accept the rules that the that the OECD has made. You accept the BEPS minimum standards, then you're welcome to participate on an equal footing. But we all know, right, that that's not the reality. The developing countries cannot. They don't have the resources. They don't have the capacity to fully participate on an equal footing with developed countries and the OECD. That BEPS 1.0 did not produce satisfactory answers with respect to the digitalization of the economy. As you know, BEPS Action 1 said, well, we don't know. We haven't been able to come up with a solution. Here are 3 things you can do in the interim. And that led a number of countries to adopt digital services taxes. The OECD and some of the larger developed countries became very concerned about that. And on an urgent basis, the work began on BEPS 2.0, and that involves Pillar 1 and Pillar 2 that are very important. Can I have the next slide, please? I don't need to spend any time on that because, as you heard from Manal and from Jan earlier, that Pillar 2 is going to be a reality, and I don't think anybody can deny that. So let's look just briefly at the policy rationale for Pillar 2. Next slide, please. So I detect 2 principles here. One is that source countries have the right to impose corporate tax. They don't have to, but they have the right to. And that's consistent with that original allocation of taxing rights. But at the same time, the complementary principle is that residence countries have the right to tax the foreign source income earned by their residents. And those 2 principles, right, come together in terms of Pillar 2. If the source country chooses not to tax or to tax at a low rate, residence countries have the right to tax that income at a rate that they think is more appropriate. They have an obligation to, once again, relieve double taxation for the source country tax, but if the source country doesn't levy any tax or doesn't levy a reasonable amount of tax, then the residence country can impose tax. The Pillar 2 was designed to deal with the remaining BEPS issues that BEPS 1.0 didn't satisfactorily deal with. And it emphasizes the fact that if there's not coordinated action to limit harmful tax competition, then there'll be a race to the bottom. The next slide, please. So the purpose of Pillar 2 is basically to ensure that all internationally operating businesses pay a minimum level of tax. And that minimum level of tax, we all know now, is 15%. And it's not limited to digital activities. Obviously, that's the primary target because it's aimed at multinationals that can do business and derive a lot of income from countries where they don't have any taxable presence, so they don't pay any source country tax. Not intended to result in double taxation, not intended to oppose tax where there's no economic profit, but it's the last bullet on that slide that I think is really fascinating and a surprising new development. In other words, Pillar 2 does not care which country collects the tax. It is structured in such a way that as long as some country or some combination of countries collects 15% tax on a multinational's income, Pillar 2 has done its job. It has established that floor under harmful tax competition and the race to the bottom. And so that idea, I think, is a powerful idea, and it's fundamental, I think, to making Pillar 2 effective. It will ensure that countries impose this tax because they know if they don't impose it, some other country will. Next slide, please. And I think in the interest of time, I'm just going to, this is just a review of the elements of the of Pillar 2 and the IIR top-up tax and the UTPR top-up tax. Next slide. So I'm not going to spend any time on that because I know we're running a bit behind. So the IIR top-up tax and UTR top-up tax, obviously, right, basically apply to tax on multinational enterprises, income earned through entities in foreign countries at 15%, but also through the UTPR, income earned in the parent of the multinational enterprise, its jurisdiction of residence, to ensure that the income earned there is taxed at least at 15% as well. An important feature that I'll just mention is the qualifying domestic minimum top-up tax, because it reduces the amount of the IIR top-up tax, and as a result, it also reduces the UTPR top-up tax, because the UTPR top-up tax only applies where the IIR top-up tax doesn't apply. So I think the QDMTT, I think every country should enact a QDMTT because it will protect it from losing tax revenue to other countries through the application of the IIR or UTPR top-up taxes. This is just the tax-sparing issue once again, right? And it's a broader problem under Pillar 2 because it applies not only to income earned through a PE, but income earned through a foreign subsidiary. It's interesting. If you follow the literature in the United States, you'll see that some commentators in the United States are complaining about Pillar 2 because they see it as an infringement on U.S. tax sovereignty, which is, of course, the argument that developing countries made about tax sparing, and the U.S. was adamantly opposed to giving tax sparing. Next slide, please. So here are just some general comments, and I'm going to be brief because I want to say a few things about the STTR. Pillar 2 is very complex, legislatively complex and administratively complex. There's increased importance with respect to financial accounting rules. There's a lot of buzz going around now about trying to manipulate financial accounting rules in order to minimize the top-up taxes. You're going to be talking about tax incentives, I know, a lot with respect to Pillar 2 during your International Tax Forum. And of course, right, it doesn't mean that countries can't give tax incentives. It's just they have to be very careful about giving tax incentives that reduce their effective tax rates to less than 15%. If that happens, then other countries are going to be able to apply top-up tax. That's why a QDMTT makes so much sense. It just eliminates the risk of tax incentives causing tax to be yielded to other countries. The other general comment, and I don't have time to elaborate on this, but Pillar 2 is driven by developed countries, and it will primarily benefit developed countries. It's not going to benefit developing countries. Going back to the fundamental question about the allocation of taxing rights between source and residence countries, what effect will Pillar 2 have on the basic allocation of taxing rights? And my answer to that is none. Pillar 2 really serves to reinforce the existing allocation of taxing rights between residents and source countries. Next slide, please. The one exception to that statement is the STTR. And this is supposed to be the payoff for developing countries for them signing on to the 15% minimum tax under Pillar 2. So it's important that we have some understanding of this. So this just came out recently, back in the summer. The model rule, it's 7 pages long. It has 42 pages of commentary. Now that's extraordinarily long for a treaty article. So ask yourselves, why is it so long? Why is it not like Articles 10, 11, and 12 that we're accustomed to, which are like maybe a page long? They have 6 or 7 paragraphs in the article. Why is this model provision so long? And it's not because it's just so important. I think when you look at it, you come to the conclusion that the extra pages, the extra length for this provision is necessary to implement all of the limitations on source country taxation under the STTR. And the thing that I want to point you to with respect to this is that it's very clearly set out that the policy of the STTR is not to change the basic allocation of taxing rights between source and residence countries. It's simply to restore them. The idea is that a country gives up some of its taxing rights. Remember, source country taxing rights are limited under the OECD and UN model treaties, right? Country gives up its right to tax that payment, right, at any rate it wants. It gives it up on the basis that the OECD says the assumption that the other country will tax it at a reasonable rate. And that, in terms of the STTR, is a 9% adjusted rate. So if you look at paragraph 15 of the STTR, you will see that the OECD has put explicitly in the model provision, which shows how concerned it is about preserving the existing allocation of taxing rights. So here's what the commentary, paragraph 251 of the commentary, says about paragraph 15. And I quote, paragraph 15 sets out the context in which the STTR was developed and codifies the understanding that the STTR does not revisit the current allocation of taxing rights between contracting states. To which I would ask you to consider the question in the next 3 days. Why not? Why not question the existing allocation of treaty rights? Next slide, please. So I also think, it is so complicated, and you look at what the UN report said recently, right? For developing countries, the rules should be as simple and easy to administer as possible. The STTR is not simple and easy to administer by any means. There are, I think I counted at least 7 limitations on source country taxing rights under the STTR. I basically got to the conclusion that the people who designed the STTR really never want it to be able to apply to allow developing countries to tax these payments. And even if you get through all of that, and you think that this is actually significant for developing countries, it assumes that developed countries are not simply going to raise their taxing rate, their taxes on these payments to 9%. And if they do, developing countries will have no right to tax. And I just think that seems to me to be a bit strange. So I'm not going to say any more about that. Let me just conclude, because I've gone on too long, and I won't say anything about the UN. Carlos can deal with that very ably. So in conclusion, just let me make a couple of very brief points. One, Pillar 2 does not make any fundamental changes to the allocation of taxing rights between residents and source countries. In fact, what it does is it reinforces that allocation of rules. Pillar 2 is going to be hugely complicated for developing countries. Indonesia, for example, is going to have 2 corporate tax systems. It'll have its ordinary corporate tax system, and it's going to have a Pillar 2 corporate tax system, right? And the STTR is going to add additional complications to that. I think there's no question in my mind that all countries, including Indonesia, should enact a QDMTT to protect their domestic tax revenues. And the final point that I'll end on is that the OECD estimates our Pillar 2 is going to raise $220 billion of additional tax revenue annually. That's not the critical question. The critical question is, who's going to get the money? And I doubt it will be Indonesia. But one thing is for certain, and it's always certain, and that is tax advisors are going to get a lot richer. So I wish you a very rewarding and interesting 3 days. I'm sure it will be fascinating. I wish I could be there to share in the discussions with you. Thank you very much.
Thank you very much, Brian. Let's give a round of applause for the insight that you have shared with us, Brian. Such an enlightening lecture. Okay, can we have Brian up on screen for the Q&A session? Okay, now you're visible. Well, before I move on to the questions, Brian, I just want you to bring you back for the first part of your lecture. Listening to your lecture, especially on the first part, on how developing countries have been at a disadvantage for so long, I was just wondering, I hope that my question is not that controversial. I wonder, in your view, if there is any hope of changing that phenomenon, and what do you think will be the best feasible way to achieve that?
That's a difficult question to answer. I think that one move that we're seeing from the United Nations, and Carlos, I'm sure will talk about this, but the UN Secretary General issued a report back in August, suggesting that that the governance framework for international tax needed to be significantly revised in order to make the United Nations the leading organization for norm setting with respect to international tax. And that would give developing countries, presumably, a bigger say in the allocation of taxing rights. But I'm not naive enough, or maybe senile enough, to believe that the OECD is going to give up its dominant position in terms of setting international tax norms without a struggle. So I guess my answer is I'm not sure.
Okay, that's a very diplomatic answer then. Okay, once again, I would like to remind all the participants here that we'll be starting a Q&A session for the remaining time. Therefore, you can raise your hand and ask the question directly to Brian. Oke, Bapak Ibu, jika ada pertanyaan silahkan angkat tangan. Ya, silahkan dari tengah. If you can please stand up and mention your name and organization, sir.
Tes. Hello, Brian. My name is Johannes, and I'm from DGT of Indonesia. Well, I have two questions. First, regarding Pillar 2, do you think how Indonesia can cooperate with other East Asian countries, especially Asian countries? Because we have mostly of Southeast Asia country are developing country. Can we do like cooperation in implementing of Pillar 2 for our benefit in our regional country as Southeast Asian country? And my second question is a little bit technical regarding STTR. So about preferential adjustment, so we have incentives in our country, and does those incentives can be stated as preferential adjustment that affect the tax rate of STTR implementation? Thank you.
The cooperation with neighboring countries in the region, I mean, I think is an excellent idea, and I can only encourage Indonesia to pursue that, not just with respect to Pillar 2, but generally with respect to tax matters. Regional cooperation, I think, is something that's desirable, and you have shared interests with countries in your region, shared interests that you don't necessarily have with other countries. The preferential adjustment that you mentioned is it's a 9% nominal corporate tax rate. So if the country in which the recipient of the payment is resident taxes the payment at a nominal rate that's less than 9%, then the STTR would apply and allow the source country to top up the tax to 9%. It would be very easy for countries to impose a 9% nominal corporate tax rate, but then have preferences that reduce the rate, either tax rate reductions or exemptions or exclusions for income. And so they've made the provision more effective, more complicated as well, by adjusting that 9% nominal rate, but they're only doing that for what are called permanent adjustments. And those determinations of whether or not a country actually imposes a preferential tax rate of less than 9% on these payments, this list of payments, is going to be a very difficult one. And remember, these are adjustments that are made in a foreign system. So if you, Indonesia, are trying to decide whether or not you can apply the STTR to a payment to residents of Canada, you're going to have to intimately understand our tax system and whether or not we have preferential adjustments that reduce our rate. And that's just part of the complexity that's involved in the STTR. And I suspect that what you'll find is that the OECD is going to be the one that is going to have to take responsibility for making those kinds of determinations. That's, I suspect, what will be the solution to that problem.
Okay, so if there is any follow-up question? Or is it clear?
So regarding the tax incentive as preferential adjustment, we need to ask the OECD, right? Is that your suggestion?
Well, yeah, I mean, you're going to have to ask that question of the OECD for every country that is potentially going to be a treaty partner that you'll want to make a request to have the STTR added to that treaty. Now, you know, a little preliminary work that I did on your treaty network, this was done, you know, a year and a half ago. I didn't see that there were many treaties that you'd be able to apply the STTR. Now, that was before the preferential adjustment was added. So my preliminary view was based on looking at other countries that have nominal corporate tax rates on these kinds of payments of less than 9%. And there weren't many of your treaty partners that had corporate tax rates that low.
Okay, thank you, Brian, for the answer. If there is any other question, okay, please.
Thank you. Hello, Brian. I'm Melanie from Fiscal Policy Agency. I have two questions. First, maybe about not Pillar 2, but Pillar 1. As we know that the MLC of Pillar 1 has already been published and it will be open for signature by the end of this year. My question is developing country urged to sign the MLC of Pillar 1 at early stage? Considering that U.S. position is now they haven't supported Pillar 1, and considering that there is maybe only less significant amount of allocation to developing countries or market countries with regards to Pillar 1. That's my first question. My second question, the MLI on STTR is also already open for signature from 2 October 2023. Again, is it urgent for developing countries to sign the MLI? As you know that our treaty rates for interest, royalty are mostly above 9%. Maybe for services, but there is a markup threshold of 8.5%. Thank you.
Oh, okay. Good questions, Melanie. Good questions. I wish I had good answers to match your good questions, but I don't. My answer to your first question is I don't know. I don't know whether you should sign Pillar 1. I can't say more than that. With respect to the STTR, I would simply say I would be very, very cautious. And that is because of something that I have not yet been able to reach out to someone from the OECD to try and get some clarification. But if you look at the model provision, and I have not checked the multilateral treaty yet about this, but if you look at the model treaty provision, if a country makes a request to have the STTR added to a treaty, and as we heard, the countries in the inclusive framework have agreed that if a request is made, they will modify the treaty. The way I read the model rules, it means that once the STTR is added to the treaty, it operates on a reciprocal basis. So it means that the developed country that has agreed to add this to the treaty can tax payments that are made to the developing country if they're taxed at less than 9%. Now, I don't think that's right. I don't think it should operate that way. But as you know, treaty provisions operate reciprocally on the basis of the sovereign equality of nations. And so I would be very cautious about signing up to the STTR. You might do it. The alternative, of course, is to not sign the model treaty, but to do it on a bilateral basis, country by country.
Okay, thank you, Brian. Mbak Melanie, if you have any follow-up questions. To all other participants, if you have any questions, please raise your hands. Okay, please, we have a question from the middle.
Hi, Brian. Good morning. Thank you for your very insightful presentation. It is very enlightening anyway. Earlier you said that the Pillar 2 is more favorable for developed countries compared to developing countries. I'm wondering whether your view is still apply or still relevant with the introduction of KDMTT, because KDMTT actually will provide the compensation for the resource countries and will prevent them from from losing their tax base with regard to the top-up tax that that will be taxed in the resident countries of their UPE if the top-up tax the effective tax rate in the subsidiary country is less than 15%. Is your view is primarily driven by the fact that the that Pillar 2 will discourage the effectiveness of the tax incentive in the developing countries? And I'm also wondering, what is your view with regard to the qualified refundable tax credit? Do you think this this instrument ERTC will can change the game? But I'm wondering whether this ERTC will be effective to at least to raise the effective tax rate in the in the source countries, so they can still provide or maintain their tax credit to attract their tax effective tax rate, and they can still maintain their tax incentive to attract the foreign direct investment to their countries. Thank you.
There's a lot in your question there. Yeah, I think first of all, I think I agree with what you said about the QD MTT and whether that will allow countries to raise revenue. I think is a question. I mean, that's the theory. The theory is that, well, if the minimum rate is raised to 15% for all countries in the world, then they're going to derive extra tax revenues that they can use to build sustainable economies. And as I say, it may raise my who's going to benefit most? Well, if you look at it just theoretically, it's going to be the countries that now don't tax at all. So if you're a tax haven and you don't tax anything, and now you can raise your rate to 15%, I mean, you've got a lot of increased tax revenues. But if you already tax everything at 15%, you don't have much to gain from Pillar 2. With respect to tax incentives, countries can still give tax incentives, but only to reduce their rates to 15%. I mean, that's generally speaking. But of course, you can give tax incentives for the substance-based to the extent of the amount of your substance-based income exemption, and you can give deferral incentives for R&D and some intangible depreciation of tangible assets. And the point that you raise about the refundable tax credits is a good one. I think what countries have to do, and that's why I think that the short-term answer is adopt a QD-MTT. That protects your tax revenue, your potential tax revenue. It just protects it, right? And then you can take on a longer-term basis, if you want to, you can take the time and devote the resources to analyzing how you deliver tax incentives, not just tax incentives, but direct grants, and see how they will affect your exposure then to Pillar 2. But you can do that on a longer term basis. You need to put something in place, right, for 2024. That's what you need to do. And unless you've done all the work that you're satisfied that you're not going to give up any tax revenue, then it seems to me pretty straightforward to say, why take the risk that you are going to give up some tax revenue? Why not introduce a QD-MTT? Like, what harm can a QD-MTT do? It makes your system a little more complicated.
Okay, thank you, Brian, for the answer. I hope it is clear for you, sir. Unfortunately, our time is up for the Q&A sessions. So a lot of good points that we've got from you here, Brian. Thank you so much for your answers. Let's give a round of applause to our keynote lecturer today. Thank you so much once again, Brian, for joining us today all the way from Canada with your thoughtful thoughts and finding on our topic. Now, before we continue with the next session today, first I would like to thank everyone involved interactively in the Q&A sessions. Thank you very much for your questions. Hopefully that's answered all of the questions that we have here. Moving on, we'll continue with the very first session of the panelist discussion today on Pillar 2 implementation and update. Now, this session will be moderated by the Director of Dhani Darussalam Tax Center Fiscal Research and Advisory, Bapak Bawono Kristiaji. Bapak Bawono Kristiaji is an experienced practitioner in public finance, tax policy, and transfer pricing. He is also the tax policy expert of Indonesia Association of Tax Center and Tax Academy called Pertapsi. He holds 2 master's degrees from the University of Indonesia in Economic Science and from School of Economics and Management Tilburg University of the Netherlands in International Business Tax and Economics. He has a strong track record of consistently writing books, articles, and journals regarding tax policy, international tax, and transfer pricing. He is also a regular speaker in various seminars, training, and group discussions, both national and international. Ladies and gentlemen, please give a warm welcome to the Director of Dhani Darussalam Tax Center Fiscal Research and Advisory, Bapak Bawono Kristiaji.
Thank you, Bu Erni, for your kind introduction. Assalamualaikum warahmatullahi wabarakatuh. Good morning, ladies and gentlemen. First and foremost, I would like to send a warm greetings to the Assistant to the Minister of Finance for Tax Compliance Affairs, Pak Yonarsal, Assistant to the Minister of Finance for State Revenue Affairs, Bu Oza Olavia, the Director of the State Revenue Policy of the Fiscal Policy Agency, Ibu Pandeputu Kakusmawardani, all officials of the Ministry of Finance, all representatives for the other ministries and institutions, including the international organization. Allow me to thank you for your invaluable presence and welcome aboard into the first session of the International Tax Forum hosted by the Fiscal Policy Agency. Grateful and humbled to be serving as the moderator for today's event. So I would like to thank you for the committee for entrusting me with this incredible responsibility. So my name is Bawono Kristiaji. You can call me Aji. So in this first session, we would like to discuss the pressing matters of the Pillar 2 implementation and update. So probably Pillar 2 can be considered as one of the hot topic currently for the international tax system. As we all know that the Pillar 2 is part of the 2-pillar solution, so proposed by the OECD and the BEPS inclusive framework that initially aim to addressing the taxation challenges in the digital economy. But the Pillar 2 itself has its 2 fundamental objectives, is to reduce the profit shifting and to reduce the international tax competition. So that is why if we look further to the Pillar 2 solution, we found that there is the so-called income inclusion rules, the global minimum effective tax rate of 15%. And currently, there are several countries ready to implement the Pillar 2 in 2024 and 2025, including Indonesia. But despite of the fast approaching implementation, I believe we still have lots of questions regarding the Pillar 2. For instance, how the rule order between the income inclusion rule subject to tax rules and qualified domestic minimum top-up tax. How we calculate the effective tax rate. What should the taxpayers anticipate and prepare? And how the developing countries like Indonesia should respond. So in order to address those questions, as well to gain in-depth understanding on the Pillar 2 and its implementation, We are honored to welcome our distinguished panel of experts. So for the next 2 hours, they will share their insights on the Pillar 2, particularly on its recent developments and the global implementations, the impact for taxpayers, as well as its implementation in Australia as a case study. Before we listen to their insights, allow me to briefly introduce our esteemed panelists and invite them to the stage. First, we have Ibu Melinda Brown, a senior advisor at the OECD Center for Tax Policy and Administration, with over 20 years of experience in international tax, specializing in transfer pricing. Ibu Melinda Brown is also an active member of the UN Transfer Pricing Committee. She is responsible for coordinating the OECD relationship on tax matters with countries in Asia and the Pacific. And last year, she started to serve as a senior tax advisor in the OECD's Jakarta office. And we are glad, Bu, to have your support to the government of Indonesia. Her current area of focus involves supporting jurisdiction in the region to participate in and implement the two-pillar solution to address the tech challenges of the digitalization on the economy. So I would like to request Bu Melinda Brown to come on stage. Ladies and gentlemen, please give her a big applause. Also, I would like to introducing our second panelist, Professor Vikram Chan, Professor Tax Law and Policy at the University of Lausanne, Switzerland. He currently also serves as the program director of the executive program in transfer pricing offered by the same university. His area of expertise includes, well, basically he's an expert of all aspects in international tax, including the Pillar 1 and Pillar 2. His notable positions and publications include the articles in prominent tax journals such as the Intertax, World Tax Journal, British Tax Review, and books by the international publishers such as Clover Law, IBFD, and so on. His doctoral thesis was shortlisted for the prestigious Franz van Stendel Award conferred by the IBFD. So, ladies and gentlemen, please give a warm welcome to Pak Vikram Chan. Okay. Last but not least, our final panelist for session 1, Pak Timothy Smith, a tax technical specialist in the OECD Pillar 2 design and implementation team at the Australian Taxation Office, ATO. He holds a master's degree in tax law from the University of Sydney. Throughout his career in international taxation, Tim is experienced in the compliance area of the ATO, leading teams to carry out reviews over some Australia large taxpayers. And on the other hand, as an advisor for the tax consultancy firm, he was responsible for advising large MNEs in respect of both their operation and cross-border transaction. So his experience and perspective sourced from both perspectives. So interestingly, over the past 2 years, Tim has been providing input into Australia's adoption of the GLOBE rules. So please give Tim a big applause and come to the stage. Yeah. Okay. Welcome all the panelists. How are you doing today? I hope that you have a marvelous time here in Bali and of course in this International Tax Forum. So before we begin this session, let me quickly recap our agenda. So each panelist in this specific sequence. So first will be Bu Melinda Brown, followed by Pak Vikram Chan, and followed by Pak Timothy Smith. We'll be delivering a presentation for approximately 30 to 40 minutes each. And after the last presentation by Pak Timothy Smith, there will be a Q&A session. So without further ado, please welcome Ibu Melinda Brown to share with us the new development of Pillar 2 and its implementation worldwide. The stage is all yours, Bu.
kasih Pak Haji. Selamat pagi, good morning everyone. I'm very pleased to be here in this International Tax Forum this morning. We've had quite a good introduction, or several good introductions to these topics this morning. It is a complex and evolving area of international tax. My aim in the next 30 minutes or so is to provide a brief update of where we're at in terms of these developments, and also just to sketch out what is involved in Pillar 2 and why the rules have been made in the way that they have been by the inclusive framework in its work over the last 4 years. Can I go to the next slide, please? There we go. So first of all, just to provide a bit of context, we've already had some discussion about the two-pillar solution and where it came from. It's intended to address a number of international tax issues or problems with the existing international tax system that have been exacerbated by digitalization. We've got Pillar 1 and Pillar 2 with complementary objectives. Pillar 1 is really about trying to address some of the deficiencies or difficulties that the existing international tax system has in terms of allocating profits that arise as a result of interactions between multinational enterprises and their markets. So we've heard about Amount A, which is the amount which would reallocate a portion of residual profits associated with connections to markets, and Amount B, which is a simplification of the existing transfer pricing rules, again talking about profits that arise as a result of interactions with markets, but this time the routine profits that arise in those circumstances. Pillar 2, on the other hand, has a slightly different aim. It's not really so much about interaction with markets specifically, but more around the existing or the remaining BEPS problem of ensuring that multinational enterprises are subject to tax somewhere in the world. Given that they can operate quite easily anywhere in the world, our intention here as part of the BEPS project and through this two-pillar solution is to make sure that we close the loop here. We have good international coordination so that multinationals are subject to taxes on their profits somewhere. So we have the global anti-base erosion rules, the GLOBE or minimum tax rules with their 15% effective rate, and the interlocking rules there that Professor Arnold was talking about that ensure that those multinational enterprises will be subject to a 15% effective rate irrespective of where in the world they operate. And I think his phrase was that it doesn't matter which country collects that tax, the point is that that tax will be collected. And then we have the treaty-based subject to tax rule, which is intended to restore source country taxing rights where those rights may have been ceded through a double tax treaty. Next slide, please. So just to provide an outline of the time frame, as Manel mentioned in her opening remarks, the inclusive framework has been working very intensively on these matters for at least the last 4 years. Actually, probably goes back much further than that. But certainly in the last 4 years, there's been intensive work. The first really major milestone, I think, was about 2 years ago in October 2021, when we had a high-level agreement by the vast majority of members of the inclusive framework, which set out the framework for the two-pillar solution. Since then, there's been a lot of intensive work by the working parties of the inclusive framework to bring us to perhaps the next really major milestone in July of this year, when we had an outcome statement by the inclusive framework on progress that's been made so far. In the interim, we've seen the publication of model rules for the global minimum tax. We've seen a number of additional documents in support of those model rules, including commentary, examples, and a number of sets of administrative guidance. And since then, we've also had, as Manel mentioned in her opening remarks, Some significant progress also on the subject to tax rule, including the opening for signature of a new multilateral instrument. And just in the last few days, we've had the publication of a multilateral convention for the purposes of Amount A. Next slide, please. The July outcome statement, as I said, was quite a major milestone in the middle of July of this year, which set out in quite a lot of detail the progress that's been made since the framework agreement in October 2021. I think I've actually covered all of that, so can I go to the next slide, please? Next slide, please. And the next one. Thank you. So to focus in on Pillar 2, which is my brief for this morning, Pillar 2, as we already know, has two separate elements, subject to tax rule and the global minimum tax. I maybe should have put these two in the other order, with the subject to tax rule on the left-hand side, because in terms of rule order, the subject to tax rule does go first. So any tax that's collected under the subject to tax rule is taken into account for working out the globe effective tax rate. So arguably we should talk about subject to tax rule first, and then the minimum tax is the top-up, it's the backstop in the event that we still have low tax income in a jurisdiction. The global minimum tax is intended to allow a country to top up to the effective tax rate of 15%. It applies to large multinational enterprises, so we're talking about enterprises with a turnover of more than 750 million euros per annum. Broadly speaking, it's quite similar to the threshold that's used for country-by-country reporting. Not identical, but broadly speaking similar. So the chances are, if a multinational is currently subject to the CBC reporting rules, it's likely to be subject to the global minimum tax rules as well. And we've talked already a little bit about the coordination between the interlocking rules. So it doesn't matter which country actually collects the top-up tax, but there is a defined rule order which ensures a coordinated approach. So after the subject to tax rule has applied, if there is a qualified domestic minimum top-up tax, that's the next one in the order of priority. And then after that, the top-down IIR, or income inclusion rule, and finally the backstop rule of the UTPR. An important feature of the global minimum tax is the substance-based carve-out, which does allow countries to continue to provide tax incentives which have the effect, or which can have the effect, of reducing the effective tax rate below 15%. And it has the effect of shielding some portion of the income associated with that investment from a top-up tax. So it means that tax incentives that are designed to encourage real investment that is backed by substance in the form of jobs and tangible assets, will be at least partly shielded from the effect of a top-up by this substance-based carve-out. Go to the next slide, please. To look at these two elements in a slightly more detailed way, looking at the various elements of the minimum tax and the subject to tax rule. The globe rules, the minimum tax rule, as we've discussed, is at least partly one of its objectives is to put a floor under tax competition. So to reduce the pressure on governments to grant ever more favourable tax incentives or tax benefits to taxpayers by ensuring that they're going to be subject to this 15% irrespective of what a particular government does. We've talked about the fact it applies to large multinational enterprises, and it will be incorporated into domestic law. So there are certainly some challenges associated with that process, but the intention is that these rules are going to be internationally coordinated, but applied domestically. It's also a common approach. So unlike the minimum standards that we had in BEPS 1, countries can choose whether or not they apply the globe rules. The common approach simply means that if they choose to do so, they agree to do so in a way that's consistent with what's been agreed at the multilateral level. And also that they accept that other countries have the right to implement those same rules. The globe rules also apply on a jurisdictional basis. So that means that there is an opportunity for multinational enterprises that have more than one subsidiary or permanent establishment in a jurisdiction to offset the income between those constituent entities. So we look at the effective tax rate of 15% on a jurisdictional rather than an entity-by-entity basis. On the subject to tax rule, on the other hand, this is the treaty-based rule, and it applies on a transactional basis to certain types of covered income, to interest, to royalties, to all payments in relation to services, and a number of other defined categories of income. Here we have a 9% nominal rate, which is potentially subject to preferential adjustments, where there are such adjustments which might reduce the amount of income that's subject to that 9% or allow for additional reductions in the tax base. Rather than applying only to large multinational enterprises, it can apply to all companies. There are, however, some de minimis thresholds there, and it only applies between connected parties that are not individuals. Let's go to the next slide. Okay, and the next one. So to focus in now on the global minimum tax rules, what we have here is really a change in the international tax architecture. Its two policy goals are to reduce arbitrage opportunities. So by ensuring that all large multinational enterprises are subject to at least a 15% effective tax rate, we are intending to reduce the attractiveness of profit shifting, because they're going to be subject to at least 15% in any case, no matter where in the world they place those profits. And they're intended to be internationally consistent and coordinated rules to make sure that the rules don't create unintended loopholes or gaps, and also, to the extent possible, to simplify the rules. There's no question that these are complex rules, and they're not necessarily terribly easy to implement. But the one thing they have in their favour is that they're intended to be very consistent internationally, which means that from a multinational enterprise perspective, the globe rules as they apply in Indonesia should be exactly the same as the globe rules that apply in any other jurisdiction. And it also means that from Indonesia's perspective, and from every other country's perspective, we can all learn from each other's experiences. So I think that's also a really important element as part of this process, is that whether that's cooperation within ASEAN, whether that's cooperation within the broader Asia-Pacific, or indeed globally, all countries that are implementing these rules will be doing so in a consistent way, and will be able to share their experiences with other countries. It's quite interesting, I think, to me that there has been a great deal of willingness by countries to do just that. I have been doing these kinds of events throughout the region for some time now, and it has been, I think, quite remarkable to me, actually, the extent to which countries from around the world are very, very giving of their experiences, of the challenges that they're facing, and not just developed countries telling developing countries how to do it, but also developing countries sharing with other countries the challenges and the difficulties that they're facing, and how they're overcoming those challenges and difficulties. I've already mentioned that the intention here is to have comprehensive and integrated rules that are coordinated around the world. And all of this means that there are implications for domestic tax policy. I think because of the way the rules operate, doing nothing is not really an option. Or rather, if you do nothing and there is the potential for low tax income arising in your jurisdiction, what will happen is another jurisdiction will gain the right to tax that income. So it's not really a good idea, really, just to do nothing. But it creates opportunities as well, in the sense that as this minimum tax puts a floor under international tax competition, it creates some breathing space for governments to evaluate tax incentives and to evaluate whether those tax incentives are actually meeting their objectives. Presumably, in most cases, tax incentives are put in place by governments in order to encourage certain types of investment, certain types and certain modes of growth. And I think it provides a good opportunity to evaluate whether existing incentives are actually meeting those needs in the most effective way. Next slide. I've mentioned already that the globe rules are a common approach. They're not a minimum standard, so it means that inclusive framework members are free to choose whether or not they implement the rules. But it remains true that even if you don't implement the rules as they're implemented by other countries are likely to affect all jurisdictions. Can I go to the next slide? So just to give a brief illustration, hopefully this is already pretty evident to everyone here in the room, but just a very simple illustration of how the mechanics of the minimum tax work. If we've got a group that we've got illustrated there on the screen of a parent co and 2 operating companies in 2 different jurisdictions, and if there is low tax income in country S of OPCO 1, then the parent company jurisdiction, the headquarters country, could have the right to impose a top-up tax in respect of that low tax income of OPCO 1 under an IIR. Alternatively, if the headquarters country does not implement the globe rules, then potentially jurisdiction B could collect the top-up tax in respect of that same income under a UTPR. However, the source country, if it implements a qualified domestic minimum top-up tax, actually has the first right, the first ability to collect that top-up tax itself, and that effectively switches off or reduces dollar for dollar, rupiah for rupiah, any top-up tax that would otherwise be payable in respect of that low tax income. So you can see with the combination of these rules, it doesn't matter, as Professor Arnold said, which country imposes the top-up tax. The point is that if there is income of a large multinational enterprise subject to an effective rate of below 15%, the chances are some country or another is going to collect that top-up tax. Next slide, please. So we've set out some quite detailed model rules and commentary and examples illustrating how those rules apply using a 5-step process. And the complexities here are partially because we are taking into account the different systems of tax that apply all around the world. And we're starting from a position of looking at financial accounting positions. So we're starting by looking at the accounting standards and using that as a slightly more common basis for working out the effective tax rate that has applied, rather than a tax basis, which is much more divergent around the world. So we start, after we've determined whether there are constituent entities within scope, we look at what is the globe income and the adjusted covered taxes which relate to that globe income. And we compare those two to come up with an effective tax rate and determine whether there is any top-up tax payable. And then the final step there is to determine where that top-up tax is payable, under which charging mechanism. So that could be in fact, a QDMTT. That's not on this screen because, I guess, strictly speaking, the QDMTT is a rule that's outside of the globe rules. It's part of it's complementary to the globe rules, but you could argue that the way that the rules were initially drafted, there's a QDMTT which applies before the globe rules start to operate. Next slide. In terms of who will be affected by this, I've mentioned already that this rule is aimed at large multinationals, those with more than 750 million euros of global revenue or global turnover, which is a similar threshold to that for country-by-country reporting. Smaller multinationals and wholly domestic entities that are not part of an in-scope group are out of scope of the globe model rules. and therefore are much less likely to be affected. Though, of course, because these are domestic rules, countries are still free to tax their own residents as they see fit. It also means, however, though, that tax incentives that are targeted at domestic businesses or startup businesses or growing businesses are largely unaffected by the rules. Similarly, investments, even by large multinational enterprises that have more substance in terms of employment and in terms of investment in tangible assets, are much less likely to be affected because of the effect of the substance-based income exclusion. On the other hand, large multinational enterprises that are within scope, that have high levels of profits but without significant substance in a jurisdiction, and those that are paying low tax are most likely to be subject to a top-up tax. Next slide, please. Can you click through, please, so that we can see the whole diagram? Keep going. Okay. So this is just basically the formula for the globe rules. You can see at the top there the comparison between adjusted covered taxes and globe income, which gives us our effective tax rate, which again we calculate on a jurisdictional basis. And then if there is a discrepancy between that effective tax rate and the 15%, there could be a top-up tax percentage, which applies not to all globe income, but only to what's described as excess profit. So that is globe income less the carve-out based on substance. So that's an important point there. And then finally, we look at the charging mechanism, and to the extent that there is a qualified domestic minimum top-up tax, that also reduces any jurisdictional top-up tax that would be charged otherwise under an IIR or a UTPR. Next slide, please. We have been, at the Inclusive Framework, developing a number of implementation tools. So in addition to the model rules and commentary, there's been quite a bit of administrative guidance to supplement those two products that have been issued by the Inclusive Framework as well. The Inclusive Framework has also been working on a standardised globe information return, which has already been completed and published. The intention there is that there will be a common return that multinational enterprises can file to meet their compliance obligations with globe rules, no matter where in the world, and that there is a possibility for that globe information return to be filed centrally and exchanged through exchange of information mechanisms where such mechanisms are available. But quite importantly, also, countries can, of course, require a globe information return to be filed locally, where exchange of information mechanisms may not be fully available yet. So we're currently working also on the administrative framework to facilitate all of this, and continuing to work on additional administrative guidance. Manel mentioned the handbook on implementation that was released just a couple of weeks ago. This is actually a very short guide on some of the key issues. I can go to the next slide, please. And here is the implementation handbook. It steps through in a very brief fashion the steps of the core provisions for the application of the globe rules, and then looks in a bit more detail at some of the implementation considerations for policymakers in terms of impact assessment, possible reform options, and also in terms of, in a practical sense, what would be required to implement the globe rules through legislation and in a practical way. Next slide, please. In terms of countries that are putting in place the globe rules, we've taken a very conservative approach on this map here. This list only includes those countries that have made specific statements publicly about their intentions. So although we all know that because Indonesia has incorporated into its law some high-level legislation allowing for the implementation of the globe rules, until we have a specific statement, official statement, we've chosen not to include countries that have, kind of indicated that they're going to implement the globe rules, but haven't specifically indicated when and in which manner. So in this region, you can see quite a number of your ASEAN contemporaries have made announcements, as have a number of significant foreign investors in the Indonesian economy. Turning to the next slide, please. In terms of what we're hearing from countries, I think a lot of countries would share the concerns that I hear in Indonesia as well around both the novelty and the complexity of these rules. The rules, I think, as I said before, undoubtedly have certain complexities. The principles themselves are relatively easy to understand, but of course, once we get into the details, in terms of working out exactly what is included and excluded from global income and how to adjust covered taxes so that we get that consistent approach around the world, there certainly are some complexities there. And that has been a commonly expressed challenge. As has the difficulty in estimating what the impact of these rules will be domestically, both in terms of where there are tax incentives and perhaps in other circumstances as well. We've heard from many countries that preparing tax administration is going to be a challenge in terms of socializing and familiarizing tax administration officials with all of these rules, as well as in terms of the systems that will be required to handle and manage the information that will need to be collected. The fact that we have internationally coordinated and internationally consistent rules does represent, I think, quite a significant step change here, but it also in some sense creates a challenge in the sense that what we have is internationally agreed rules which then need to be translated into domestic law in each domestic context. I know you've got another session on the implications for tax incentives, but I think that is one that's a very significant and very commonly expressed challenge in relation to these rules, certainly in this region. It's something that I hear a lot from other ASEAN members in particular. The implications here for tax incentives, where you may have a corporate tax rate that's above 15%, but certain tax incentives regimes which may create pockets of low tax income for good policy reasons. So in terms of how those incentives will operate and how they'll be affected by the globe rules being implemented around the world is something that many countries are currently grappling with. Important to note, I think, because of the way that the globe rules work, that of course not all tax incentives will be affected in the same way. It will depend on whether those tax incentives affect either income or taxes or operate in slightly different ways, depending on how they affect that effective tax rate equation will differ in each case. So there are some challenges there, but also, as I mentioned before, potentially putting a floor under the race to the bottom does create opportunities as well for governments to consider how their tax incentives are functioning and whether they're meeting their policy objectives. Next slide, please. And again, next. Thank you. So in terms of just where we are going from here, this takes us back to the start of the project, but from here we're looking at a little bit of additional administrative guidance as we race towards the start of implementation. A number of countries are implementing the globe rules from as early as the 1st of January next year. Several others, particularly in this region, I think have announced that they are working on implementing the globe rules, but may be looking to put the start date of 2025 rather than 2024. So we are looking at perhaps a couple of years of a phased-in approach around the world where the rules start to operate. Next slide. I turn then in my last 5 minutes or so to the subject to tax rule. Next slide, please. This is a fairly, I was going to say recent development. It's been on the table and under intensive discussion at the Inclusive Framework for a long time, but the most recent developments was just in the last few months we have seen the release by the inclusive framework of a strong, solid framework for the subject to tax rule, a report on the subject to tax rule, and the release just a few weeks ago, or rather the opening for signature just a few weeks ago of a new multilateral instrument to help facilitate the implementation of the subject to tax rule. I mentioned at the beginning a comparison between the subject to tax rule and the globe rules, and they are in some sense complementary in the sense that one of the trade-offs in terms of the rule order and having the income inclusion rule apply before a UTPR, not only that it's in a practical sense a much simpler way to do things, but the subject to tax rule was a part of that negotiation process. So the subject to tax rule, as I've mentioned already, is a treaty-based rule looking at ensuring that certain types of covered income between related or connected persons is subject to at least a 9% nominal rate. And this basically unblocks the source country taxing rights where they may have ceded those taxing rights under a treaty. Next slide. The basic steps here, we seem to like 5-step processes. So here we've got another 5 steps. First of all, looking at scope in terms of who this applies to. It's not restricted to large multinational enterprises, but it does exclude individuals. It also excludes a limited variety of entities similar to the globe rules, such as non-profits and so on. And then we look at the types of covered income. So I've mentioned already interest, royalties, and payments for services, but other types of income that are also within the scope include payments for distribution rights, insurance and reinsurance premia, financial guarantees and other financing fees, rent for the use of industrial, commercial, or scientific equipment. The third step here is around a materiality threshold. So this is one of the features of the subject to tax rule that is intended to focus the rule on the sorts of payments that are more likely to pose a risk of being base eroding. So we don't apply the subject to tax rule unless the materiality threshold has been met. And that materiality threshold is that the total of the covered income between the connected persons in one jurisdiction and connected persons in the other jurisdiction of the same group exceed €1 million. So this means that we can't actually know whether the STTR will apply until the end of the year because we need to work out whether the materiality threshold has been met. Then in step 4, we look at whether the income was actually subject to a less than 9% nominal rate. And here we start from the statutory rate as it may be adjusted by various preferential regimes. And then we take into account whether there are any preferential adjustments to the tax base. And finally, we may need to look at the markup threshold, which applies for categories of income other than interest and royalties. So interest and royalties, we don't need to look at the markup threshold, but for others, again, with the aim of focusing the subject to tax rule on the types of payments that are more likely to pose a BEPS risk, we look at those that have a markup on direct and indirect costs of more than 8.5%. Next slide, please. I mentioned before that because of the materiality threshold and for a number of other reasons, we're looking at an ex post calculation of the STTR. So there would need to be a year-end evaluation of whether the STTR applies to determine how much potentially top-up will be required. So a number of reasons for that. I've mentioned the materiality threshold, but also we may need to look at the markup threshold as well, and to look at the end of the day whether there has been preferential adjustment to the tax base made up of the covered income. Next slide, please. To give a brief example here in terms of how the STTR works, and I've included this because I know the STTR is still relatively new to many of us. If we've got connected parties is the terminology used in the STTR, ESCO and ARCO in different jurisdictions, and there is a payment of, let's say, €100 of one of the types of covered income, so interest, royalties, a service fee, or something similar. And in this situation, we have in jurisdiction S, let's imagine that the domestic law provides for a 15% withholding tax on that type of covered income, but double tax agreement between S and R states limits the tax that can be imposed by country S on that type of covered income to 3% using a withholding tax. Then if we look at the situation in country R, if the covered income in the hands of ARCO is subject to tax at 4%, this would be the effect. First of all, we look at whether the income has been subject to the 9% rate of tax already or not. It hasn't. It's been subject to 4%, plus the 3% under the double tax agreement. So the double tax agreement already allows source country S to tax at 3%. The STTR would allow country S to increase that up to the specified rate, so up to the difference between the 9% nominal tax rate and the 4% that has already been taxed in jurisdiction R. So the overall effect being that under the treaty between S and R, S can now tax that covered income of 100 at a total of 5%. So 3% using the withholding tax that's under the regular provision of the treaty, and an additional 2% through the STTR. Remembering, of course, that the STTR amount would need to be collected following an ex post annualised charge approach. Next slide, please. So I think one of the important things that I wanted to mention about the STTR is the implementation process. As part of the October 2021 agreement within the Inclusive Framework, developing countries that are members of the Inclusive Framework can make a binding request on any other member of the Inclusive Framework to include the STTR in their treaties where the counterparty jurisdiction has nominal tax rates on categories of covered income below 9%. That can be done via the MLI that's just been released, or it can be done bilaterally as an alternative. So the MLI for the STTR has been open for signature for a few weeks now. And the process that's currently underway, being facilitated by the OECD Secretariat, is to help countries to identify which treaties are likely to be affected, and in what cases a country may choose to make a binding request to include the STTR, or in what cases countries are likely to receive such a request from a developing country. So the process has involved asking all members of the Inclusive Framework for information about, first of all, their tax treaties and who they have tax treaties with, and second of all, about their nominal tax rates on the various categories of covered income. So we are trying to help countries to identify whether they actually subject those categories of covered income to rates of tax below 9%. So we are working with countries to identify those particular situations, and then matching that up with their treaty networks to see whether they may be subject to a request from a developing country, or whether they themselves, if they are a developing country, would be entitled to make such a request of another country. An important point to note, I think, here is that developing country Inclusive Framework members can make a request of any other Inclusive Framework member, whether that Inclusive Framework member is a high-income economy or another developing country. Next slide, please, which I think is the last one, yes. So this process is still underway, and it's still ongoing. It's not necessarily a straightforward process, as Professor Arnold mentioned, we do need to look at what rates of tax the various different types of covered income is subject to in each country and with respect to each treaty. But it's a process that is where we're working collaboratively with all of the members of the inclusive framework. So it's a significant area of our focus at the moment. I hope that has been a useful introduction. Contact details are on the screen there, and I'll yield my time to the other panelists. Thank you.
Okay, thank you, Ibu Melinda Brown, for your insightful talk. If I may, I would like to recap several key points that deserve attention from all of us. So, Bu Melinda Brown already explained to us the comprehensive explanation about the Pillar 2, the scope, the background, the affected taxpayers, and also the computations. And furthermore, Bu Melinda also shared with us the country's experience on the Pillar 2. So she raised three experience so far. First is the novel rules, so how the country formulate the legal framework into its domestic provisions, preparing the tax administration, and so on. And the second one is to ensuring the international consistency. As we all know that if country want to adopt the Pillar 2, they have to comply with the model rules and also the commentary from the OECD. And the last one, the implication on the tax incentive. And if I may, I would like to quote the interesting statement from Ibu Melinda Brown, as she said that the do nothing is not an option. So even though the Indonesian government do not want to implement the Pillar 2, well, basically it can affect the investment and also the tax base in Indonesia. So I believe, thank you, Bu Melinda Brown, for your insightful discussion. Now we move forward to the second panelist, Bapak Afrikam Chan. Are you ready, Pak? Okay, the stage is all yours, Pak Afrikam Chan.
Thank you for that introduction, and welcome everyone to this fantastic forum. First of all, I would like to thank the organizers for actually inviting me to this beautiful and gorgeous location in Bali. I'm super happy to be here, and I'm very excited to be here in Indonesia. And I'm already enjoying all the interventions of the other speakers, and I hope my intervention is also insightful for all of you. Standard disclaimer, whatever views I'm going to express in my presentation are my own personal views. They don't represent the views of all the organizations I sometimes do work for or I'm associated to. So in terms of Pillar 2, what I'm going to address is basically what is the impact of Pillar 2 on taxpayers. And to do that, what I'm going to do is I'm just going to first of all, try to figure out how to change the slides. That's what I'm going to do first. So who's controlling the slides? Should I do it from here, or it's happening automatically? Okay, sorry. So let's do it like this. I will say click, and then you can just click on the slide, and then you can change it like that. So I'll just give you an overview of how the Pillar 2 rules work. We've already heard what the other panelists have said. So for the first point, it may be a bit repetitive, but I will do it in the form of case studies. For the second point, I will tell you what are the taxpayers doing. What is the taxpayer behavior that we observe among large multinational enterprises? What are they effectively doing, basically, to somehow circumvent the Pillar 2 rules, to fall outside the scope of Pillar 2 rules? I'll explain that to you with a couple of case studies too. Third point, I will just try to speak to you about what are the post-Pillar 2 implementation responses that multinationals are looking at. We've already touched upon the topic of tax incentives. Tax incentives is a very sensitive and delicate topic. All multinationals want tax incentives before they make an investment in a particular country. So what are multinationals doing in that area? Click. Point number 4, I will try to discuss the tax compliance or the compliance nightmare that the multinationals have to go through with respect to these Pillar 2 rules. Because when you talk about Pillar 2 rules, you have the GLOBE rules, income inclusion rule, UTPR on one hand, you have the QDMTT rules on the other hand, then you have the STTR on the third hand. So the taxpayers really have to comply with a lot of rules. Click, and finally, I will talk to you a little bit about the tax certainty dimension, which is somehow still missing in the project, and I will try to just explain to you what are the taxpayers' wishes here. So let me just start with the overview. If we can go to the next slide. Next slide. Well, basically, just to give you an overview of how the Pillar 2 rules work, there's a particular rule order, how the Pillar 2 rules are supposed to work. If you click, you will see that the first rule that applies in the entire Pillar 2 framework is the subject to tax rule. Melinda already gave a couple of examples of how that works. Then we have the qualified domestic minimum top-up tax rules. Then we have the standard GLOBE rules, which is the income inclusion rule and the under-tax profit rule. If you go to the next slide, let's start with the subject to tax rule. The subject to tax rule is very simple to understand in theory. So for example, in this case, if we have a payment that is being made by an Indonesian company, which is ESCO, to a recipient, which is ARCO in country R, let's assume that a $1,000 of service fee is paid from ESCO to ARCO, and the relevant tax treaty says that the income is taxed only in the state of residence. In this case, basically, Indonesia can impose a 9% STTR on the assumption that the recipient or the tax rate in the recipient's jurisdiction is is almost 0%. So if you assume that the corporate income tax rate in the recipient's country is 20%, but because of a tax incentive in the recipient state, the taxpayer, ARCO, does not pay any tax. In this case, the preferential adjustment provision would apply, or the tax rate provision would apply, and basically say that Indonesia has a right to collect 9% STTR top-up tax. If we click, if you could just click, yeah. So basically, if the STTR tax applies in Indonesia, the question is, how do you treat it from the perspective of the GLOBE rules? So just to let you know, in this case, if Indonesia applies the STTR tax of up to 9% on this particular service fee, this 9% tax is taken into account for the purposes of the GLOBE rules and the QDMTT rules. So the STTR applies first. So as in this particular case study, the 9% withholding tax, which is collected through the STTR, is actually pushed up to the recipient. Basically, this goes and sits in the numerator of ARCO. So ARCO's numerator would basically show that it is paying 9 of taxes on an income of 100, for example. Then the tax rate in country R would be 9% before the QDMTT and GLOBE rules apply. And once they kick in, then ARCO will have to pay a top-up tax to its own state tax administration if a QDMTT is introduced there. So the bottom line here is that the STTR rule applies first, and it gives the source countries the right to tax. Now, whether this rule the question is whether Indonesia should adopt this rule or not. Like Professor Arnold mentioned at the start, I would also say you have to be extremely cautious before actually adopting this rule. Why is that the case? Well, first of all, apart from interest and royalties, so my understanding is that Indonesia already has withholding taxes on interest and royalties, which it also preserves in its tax treaties. So this rule will apply to a selected stream of payments, and basically this is all subject to a markup threshold in the state of residence. Because if the markup threshold in the state of residence is less than 8.5%, well, basically the rule gets switched off. It does not apply. So just be careful before you think about signing the MLI for this. We can have a further debate on this, and actually we are going to on day 3, where we will be going into the technical details of the STTR. Next slide. So, well, basically that's how the STTR operates. Now, just to show you how the QDMTT operates, it's very simple. Click, click. Basically, in this particular example, You have ARCO, which is in the state of, which is in country R, where the effective tax rate is more than 15%. And ARCO has 3 subs, S1 Co, S2 Co, and S3 Co. And basically S3 Co, let's assume it is in Indonesia, and it has an effective tax rate of less than 15%. Why is that the case? Because the sub has access to a tax incentive. Well, basically in this example, the question is, can Indonesia collect the top-up tax locally? The answer is yes, as long as Indonesia adopts a qualified domestic minimum top-up tax. So if you click, you will see that in this particular case, Indonesia can collect the top-up tax. So if you assume that S3 Co has a tax rate of 10% because of a tax incentive, then Indonesia can collect a 5% top-up tax through this QDMTT. So QDMTT may make sense for the government to adopt. At the same time, QDMTT is backed by QRTCs, qualified refundable tax credits, because these are some kind of tax incentives which you can still provide to the taxpayers and give some benefits to the taxpayers to still to ensure that the country is still attractive from an investment standpoint. This is on the with respect to the QDMTT, and if you go to the next slide, I would just like to mention to you that the QDMTT would apply to a situation where the profits of ESCO, which is in Indonesia, are low taxed. Now, one of the questions that has been raised in not only in academia but also by governmental organizations is, what about the interaction between QDMTT and bilateral investment treaties? If you click 2 times, the question is very simple. The question is, can the investor from country R here invoke a bilateral investment treaty? Click, and basically tell the country S here, Indonesia, that you are not allowed to impose a QDMTT on us. Why? Because you have given us, or you have agreed to give us, a tax incentive for 20 years or so, something like that. So can the taxpayers invoke the bilateral investment treaty and tell Indonesia not to collect the QDMTT? Well, the answer is very simple. If they want to do that, they can go ahead and do it. But if they don't pay the top-up tax in Indonesia, then they will have to pay the top-up tax in country R through the income inclusion rule. And the recent guidance also, which was issued by the OECD in July, also makes it somehow unappealing for investors to go through this bilateral investment treaty route and basically start litigating against a host state. And to be honest, a lot of multinationals I talk to, they are basically saying, why would we challenge a country's QDMTT regime? We will not challenge it for 2 reasons, basically. The first reason is, well, like I already mentioned to you, if we don't pay top-up tax in the source country, in Indonesia in this particular example, then we have to pay the top-up tax under the income inclusion rule in country R. That's the first reason. The second reason is reputation. Now, which multinational, like a large, big multinational, wants to enter into a dispute with the government where they are basically suing the government under the bilateral investment treaty space? In academia, probably, it would make sense, yeah, we can sue a government, but, the reality is multinationals, they think 10 times before suing a government, before an arbitral tribunal. So, the chances of someone suing a country for introducing a QDMTT at least is low, but, there may be some taxpayer who just wakes up one fine day and says, well, you know what, I love paying taxes in my own country, not in the source country, so I will just pay taxes in the home state, not in the source state. Period. Someone may do that. So if we move on, this is some remarks. These are some of my remarks with respect to the QDMTT. Next slide, please. And then the question is, how does the income inclusion rule apply? Well, that's very simple, actually. In this particular example, we have a UPE in Indonesia, and the UPE has 3 subsidiaries, S1 Co, S2 Co, S3 Co, and state S1, the company S1 in state S1 has less than 15% effective tax rate. Why is that case? Probably, if it's in Singapore or Hong Kong or Mauritius, then the tax rate already is pretty low there. Plus, on top of that, you add a tax incentive. probably the effective tax rate of that particular entity, S1 Co, is less than 15%. So if the tax rate of S1 Co is less than 15%, then it's very simple here. Indonesia can adopt the income inclusion rule and already tax the entity S1 Co's low tax profits. So that could be a policy choice which Indonesia can really think about whether or not to adopt an income inclusion rule. Click. So that's a policy question. Should we adopt the income inclusion rule? Well, if you already have a strong CFC rule, so you have two options: strengthening the existing CFC rule, or just leave the CFC rule the way it is and adopt a income inclusion rule. That's a policy choice. We can speak about the pros and cons separately in a separate discussion. But that's how the income inclusion rule works. If you move to the next slide, there's one particular rule of the project which is not really liked by the United States, which is the undertaxed profit rule. Now, this is one rule where a lot of US multinationals have already said in public that they will be ready to sue government's introduction of the UTPR, essentially. Basically, they would like to, they may consider this to be a treaty override, this rule, the undertaxed profit rule. Probably the other rules also, like the income inclusion rule is a treaty override, but CFC rules are widely accepted among all countries, so the chances of there being a treaty override is a bit low, but still it exists. But for the UTPR, it's clearly a tax treaty override. I've expressed this view in my publications and also with other professors too. In academia, there is strong belief the UTPR overrides tax treaty obligations. If you can introduce only QDMTT and IIR, that would be very good. But the UTPR is quite a sensitive rule if one of your biggest investors into the country is the US. Because apparently the US Republicans, they've been sending letters to various embassies telling them about not to apply the UTPR because this is extraterritorial taxation. So this is going to be very interesting because in the European Union, UTPR is really going to be adopted by all the EU member states because it's coming through an EU directive. So the politics between the US and the EU is going to be very interesting to watch and observe over the next couple of years. How does the UTPR apply? It's very simple. If you just continue with the previous example, if S1 Co is a low taxed entity, and if S1 Co's low tax profits are not collected, the top-up tax linked to S1 Co is not collected by R Co because of the there is no income inclusion rule, then any other country in which the multinational operates, for example, if the multinational has presence in Germany and France can apply the UTPR and collect the top-up tax linked to S1, even though Germany and France have no connection with country S1. That's why it's a challenging rule. Even Professor Arnold had mentioned this, that you have to pay tax somewhere. So it's basically, I have a cousin in Australia, and well, I'm a tax resident of Switzerland right now. I have a cousin in Australia. If Switzerland doesn't tax me on some income, then Australia suddenly taxes me, my cousin, not me, taxes my cousin. And basically that's a bit absurd, right? That kind of system, but this is how the UTPR has been designed. So it's a devilish rule, to quote other commentators. They're not my words, but other commentators' words. So if you move on, next slide, please. In terms of implementation, from a taxpayer standpoint, taxpayers, out of all these years they're concerned about, they are mostly concerned with 2026 June, because that's the time by which they have to file the first GLOBE return. So for the financial year 2024, they have to file the GLOBE information return or the QDMTT return by 2026. So taxpayers are concerned about that deadline, and a lot of big multinationals, they will have the systems in place. So for example, when I speak to big companies with more than 20 billion or 30 billion of revenue, of course, they have a big team in place who is looking after the Pillar 2 project. But the multinationals between 750 million to 5 billion, 10 billion or so with their consolidated revenue, they are like, oh, this is going to be a compliance nightmare for us. First of all, they don't have the budgets, or the CFO has not given them the budgets to make the Pillar 2 calculations, to hire external advisors. So some tax directors I'm speaking to in small multinationals, let's say a multinational which has more than 1 billion of turnover, the CFO has told them to make all these calculations of Pillar 2 on an Excel sheet. On an Excel sheet with so many these complex calculations, probably it may work for 1 or 2 years, but you need a data-based solution for this stuff. You need a technology-backed solution. Otherwise, the chances of making errors is so high in this Pillar 2 framework. So if we move on, next slide, please. What have been pre-Pillar 2 implementation responses of multinationals? So whatever I'm going to say right now is a bit sensitive, but please, I will say it because this information is available in the public domain. Next slide. So what multinationals are doing is as follows. Just for you to know, these rules apply to multinationals with more than 750 million of turnover. And a multinational is within the scope of these rules if its revenue exceeds more than 750 million in at least 2 of the 4 fiscal years immediately preceding the tested year. So basically what multinationals are doing is they're trying to somehow split their multinational groups in order to ensure that they fall below the 750 million turnover. Next slide. I'll give you an example. So, no, if you go back one slide, too fast, you're faster than me. So basically here, just to give an example, if we say we have a UPE, and the UPE has 2 businesses below it. You have business 1, let's say it's a banking business, and let's say business B, which is automotive business. Let's assume that both businesses are 400 million each. Together, these businesses are 800 million. So if the multinational basically leaves the Pillar 2 rules or just follows the Pillar 2 rules without doing anything, then they are within the scope of the Pillar 2 rules because their group turnover is more than 750 million. So here what multinationals are doing is very simple. Some privately owned groups, and again this is in the public domain, I've read it in some articles, they are demerging their businesses. They are demerging their businesses so that 2 UPEs can be created here, and each UPE will have its own business. So in this manner, you have the same shareholders, individual shareholders, because the Pillar 2 rules don't apply at the level of the individual shareholders. They apply at the level of the UPE, the ultimate parent entity of the multinational group. So they are splitting their businesses, and if you split the business here between business A, business B in 2 different multinational groups, then possibly you can fall outside the scope of Pillar 2 rules. So this is one example of what multinationals are doing. Next slide, please. Another thing which multinational enterprises are doing is that they're trying to somehow game the safe harbors that have been introduced by the OECD whenever there's a possible chance to do it. So you would have already heard about this, and some of our other speakers also said that the Pillar 2 rules are a complex set of rules. To compute this effective tax rate is a complicated mechanism. So if you click, basically some simplifications are provided by the OECD's work for taxpayers. Many simplifications are provided. So there's something known as a de minimis exclusion. There's an exclusion of UTPR for new M&E groups. There is a transitional UTPR rule, a permanent QDMTT safe harbor. But I'm not going to talk about those two. What I'm going to focus right now is this transitional and permanent safe harbors. So if you go to the next slide, what I just wanted to mention to you is that, click again, please. So the transitional safe harbor basically says that multinationals can compute their effective tax rate in a much more simpler manner. The objective of introducing a transitional safe harbor was just to ensure that the multinationals can somehow, they have some kind of ease of computing their effective tax rates. And basically 3 rules were proposed there. One is a de minimis test, another one is a simplified ETR test, and another one is a routine profits test. If a multinational can have access to these 3 potential safe harbors in order to somehow compute the ETR in an easy way. Now, one of these safe harbors, which is most widely used by multinationals currently, is the simplified ETR test. The simplified effective tax rate test basically looks or computes the effective tax rate of a multinational group in a particular country by having a simplified way through in which covered taxes are reflected in the numerator of the formula and the way the denominator of the formula to compute effective tax rates. So just a few steps back, it's very simple here. The logic is very simple. So if you think about it, the numerator to compute effective tax rate is your taxes paid by your globe income. If your taxes paid is 10, your globe income is 100, your effective tax rate is 10%. Now what multinationals are trying to do here is that they're trying to reduce the denominator. So if you, once again, if your taxes paid is 10, your denominator is 50, not 100, if it's 50, then your effective tax rate is 20%, right? So how do you achieve that? Well, it's just through some hybrid loans that can be given. So in this particular example, you have a UPE, which is in country R. The UPE has two subsidiaries, one in country S, which is a low tax subsidiary, and another company in country T, which is a high tax subsidiary. So TICO gives a hybrid instrument, let's say a hybrid loan to ESCO, and ESCO makes a payment for that particular hybrid instrument. The payment is usually considered to be deductible for financial accounting purposes, and it's considered to be the income of TICO for financial accounting purposes. From tax law perspective, it's neutral because the payment is considered dividends for tax law purposes. So it's not a deductible expense from TICO's and ESCO's angle. Here, the point here is very simple. That what multinationals are trying to do is they are trying to somehow take advantage of the simplified test, and the way they can do, the way through which they're doing is by booking excessive interest deductions or deductions for financial accounting purposes. Now, there's one multinational who I spoke to who's thinking of throwing a big party in a particular country because when you have a big party with big expenses, let's say 10 million of expense sitting in the financial entity's books, basically in that particular country, for tax law purposes, that is not allowed as a deduction, no problem. But for financial accounting purposes, it's allowed as a deduction, a big party cost, a big festival cost or a party cost. So that why are they planning to do that? Is very simple. Because they want to reduce their denominator. With the numerator being the same, the denominator gets reduced, so your effective tax rate goes above 15%. So there are some ways you can still, or multinationals can optimize their structures. And I'm pretty sure the OECD is aware about these structures. The UN is also aware about these structures because they've been discussed. This is coming from tax administration's point of view also, so especially in the European countries. So they know about this stuff. And basically, the question is, how do you combat all these structures? Well, the answer is general anti-abuse rules. And luckily, Indonesia has one. And we'll be speaking about this rule in tomorrow's session. If you go to the next slide, post-Pillar 2 implementation responses of multinational groups are as follows. Next slide, please. What multinationals are doing is they are actually re-evaluating their future investments in countries. So like I told you, tax incentives is a very sensitive topic. So the Pillar 2 rules really have a big impact on tax incentives. But let me be clear, when you talk about tax incentives, it's mostly income-based incentives, not expenditure-based incentives. Some expenditure-based incentives are also impacted, but the biggest incentives that are impacted by the Pillar 2 rules are income-based incentives. And unfortunately, income-based incentives are the incentives used widely in developing countries, not only in Indonesia. Whereas expenditure-based incentives, such as tax credits, they are somehow offered mostly in the developed country world. So the developed countries, they are the ones who are basically drafting the Pillar 2 stuff, so they have somehow squeezed in their tax incentives, or they've protected their tax incentives, but a lot of other tax incentives are unaffected, especially the tax credit regimes. So what multinationals are currently doing is, if you click again, what they're doing is that some of them are actively engaging with governments to see whether the particular country's government will move into this qualified refundable tax credit regime, or whether they will have this marketable, transferable tax credit regimes, which are somehow blessed by the Pillar 2 project. So there's active discussion by multinationals with not only developing countries, but also with investment hubs, because investment hubs are also really deeply impacted by the Pillar 2 project. So there's a lot of discussions that takes place between MNEs and investment hubs. And one of the discussions also relates to subsidies. If you go click, a lot of multinationals are also actively asking governments, okay, probably you won't be able to give me a tax incentive, but what else can you give? Can you give me some cash back? Well, there's active discussions with a lot of governments around the world, which multinationals have, is can you give us some cash subsidies? For developing countries, it's very difficult to give cash subsidies, but for investment hubs and developed countries, it is possible for them to give subsidies. Within the EU, Germany is giving a lot of subsidies. Actually, the European Union itself is giving a lot of subsidies for taxpayers who are doing business in a sustainable manner, for ESG-related activities, for using new technologies which reduce somehow the pollution that is emitted in the air. So for all these kind of things, tax incentives or subsidies are being offered by developed countries' governments. Developing countries are a bit constrained here because giving cash is always difficult, but for investment hubs and some developed countries, it's still possible. Next slide. So this is just a slide which shows you how the Pillar 2 impacts tax incentives. And like I mentioned to you already, the biggest incentives it impacts are income-based incentives, which are mostly offered in developing countries. Expenditure-based incentives, such as qualified refundable tax credits, they are protected by the project. Also some incentives which provide for immediate expensing and accelerated depreciation, they are also protected by the project. So, still there's a lot of room for multinationals to reduce their tax rates effectively to 0%, but from a Pillar 2 angle, it will be above 15%. So just to repeat, I want to emphasize on this point. When a taxpayer is operating in a country which has a fantastic qualified refundable tax credit regime, in that particular country, the taxpayer will effectively pay 0 to the government, but for Pillar 2 purposes, the way the rules are designed, the effective tax rate of that particular taxpayer could be above 15%. It sounds a bit bizarre, but that's the reality. So one of the policy objectives of Pillar 2 was to put an end to tax competition. Does that achieve that objective? The answer is no, it doesn't. It just changes the tax competition, the level playing field on tax competition. So if you move to the next slide, from a tax compliance standpoint, so far I just mentioned 2 points. One is pre-Pillar 2 responses, post-Pillar 2 responses, what multinationals are doing. One of the biggest nightmares for multinationals is, right now, the tax compliance associated with this project. Now, this is not only associated with the GLOBE rules, but also with the STTR on the assumption that is agreed among countries. So if you go to the next slide, from the tax compliance standpoint, recently a document was released on the GLOBE information return. Now, this GLOBE information return, to be honest, is like 80 pages. So far, it's not yet over. It's 80 pages of a tax return document which a multinational, which is within the scope of these rules, has to file with its home state tax administration. Fine, we can still do that. But keep in mind that there's another rule of the Pillar 2, which is the QDMTT rules. So if I have to give you an example, if you take a Swiss parent, ultimate parent entity in Switzerland, which has subsidiaries in 100 different countries, in Switzerland, this company will file, the ultimate parent entity will file the GLOBE information return with the Swiss administration. But if all the 100 other countries in which the multinational operates introduce QDMTTs, the question is whether they have to file a separate QDMTT tax return. I personally think yes, they will have to file a separate QDMTT tax return, and countries will still have to develop this QDMTT tax return because this has to be in national law, in local law, it's local law rules, so national law would apply. And there are many differences between GLOBE rules and QDMTT rules. So this multinational, in addition to filing a GLOBE information return in Switzerland, one tax return, will have to file 100 different tax returns through QDMTTs. Probably they will leverage on some of the information contained in the Globe Information Return to fill up the QDMTT return, but the QDMTT tax returns have to be customized to each and every jurisdiction, because jurisdictions have different policy choices they can adopt in QDMTT rules, which adds to the complexity of this project. If you go to the next slide, just to show you, in order to prepare the Globe Information Return, a multinational needs to somehow gather 232 data points. That's why I said it's very difficult for this to be done in an Excel sheet. It has to be done through a technology tool. And these technology tools currently are offered by the Big Fours and other international consulting firms. These tools are offered by them, and these tools really cost a lot. Because these tools cost a lot, some tax directors or CFOs are not giving appropriate budgets to their tax directors to actually buy these tools, this software, to do these complex top-up tax calculations, because it's just costly. Multinationals between 750 million to 10 billion, they are a bit annoyed with these rules because it's just additional compliance cost for them. Probably, and this does not even result in a lot of top-up tax for the governments. Moving on to the next slide, and this will be the last point, I promise, I'm already over time, is the tax certainty dimension of the project. Multinationals are really concerned about the tax certainty dimension of the project. Why do I say that? If you go to the next slide, already the way the Pillar 2 rules work is complex. Fine, it's still easy somehow to explain it. But when you go into the calculations of the effective tax rate for the purposes of the GLOBE rules, so when I say GLOBE, it's the income inclusion rule and the UTPR. There's a certain way you need to make these ETR calculations. But then for QDMTTs, the administrative guidance, which was issued in February and in July this year, gives a lot of countries to depart from the GLOBE rules with respect to QDMTT. So for QDMTTs, qualified domestic minimum top-up taxes, countries can actually depart from what has been agreed with respect to the GLOBE rules. For example, substance-based income exclusion. If Indonesia wants, you may enact a QDMTT and say, we don't provide for any SBI carve-out. I don't think you should do that, but in case a particular country wants to do it, they say, we don't give you SBI, we don't give you SBI, but that's fine. You'll still have a QDMTT in place. The minimum rate for the GLOBE rules is 15%, but you can set your QDMTT at 20%, no problem, you can do it. You can set your QDMTT at even 30%, but then have these qualified refundable tax credit regimes, which helps the multinationals to drop the effective tax rates to effective cash tax rates to less than 5%, 4%, 2%, whatever. But the point here is that many deviations are permitted between GLOBE rules and the QDMTT rules, and this just adds to the complexity of this project. And one of the unfinished pieces of this entire project relates to the tax certainty dimension. If you move to the next slide, you will see that, on the next slide, that basically currently work is ongoing at the inclusive framework level on the dispute prevention and the dispute resolution mechanisms. Now, with respect to QDMTTs, my position is very simple here. Whenever you have a qualified domestic minimum top-up tax and the taxpayer multinational group has access to this QDMTT safe harbor, in any dispute related to the QDMTT is a local tax dispute. It is not a cross-border tax dispute. It's a local tax dispute. So your local rules for tax dispute resolution should apply. But on the other hand, if your QDMTT is not a qualified QDMTT, or the QDMTT is basically the multinational group doesn't have access to this QDMTT safe harbor, and the QDMTT somehow applies in conjunction with the income inclusion rule and the UTPR. So the point here is that when the allocation of taxing rights or allocation of top-up taxes is made within a multinational, and every country has a right to tax those top-up taxes either through the QDMTT, IR, and UTPR, because sometimes these rules can apply parallel at the same time. In those kind of situations, which could be very less, you still need a cross-border dispute resolution mechanism in place. Cross-border dispute resolution mechanism is somehow the weak point of this project at this moment. Why? Because to avoid cross-border tax disputes, the standard route is tax treaties. Typically in tax treaties, you have the mutual agreement procedure. Now this mutual agreement procedure, the question is, does it apply to globe-related disputes, QDMTT-related disputes? The answer is no, because these are domestic law disputes. These are not tax treaty-related disputes. So whenever there's any dispute associated with a misinterpretation or misapplication of these rules, the governments or taxpayers, they don't have access to Article 25.1 or 25.5, which deals with arbitration of tax treaties. They can go through this provision. You know, there's one particular provision in tax treaties, 25.3, second sentence, which basically says that countries can negotiate with each other, whatever, through something known as an interpretative map. We can somehow resolve this case, where basically the tax administrations of two countries can sit together. But this rule, in practice, is hardly applied. Not many countries are applying Article 25.3, second sentence, on a regular basis. So the legal basis may exist there, but this legal basis does not provide tax certainty to the taxpayer, because the taxpayer is left at the mercy of the two tax administrations with no binding mechanism in place to solve the particular dispute, because you don't have access to arbitration. There's no guarantee that the case will be heard and accepted by both the parties in question. The focus of the rules have to really be on dispute prevention, because the resolution side is a bit dicey. So the prevention mechanism is something on which more work has to be done. So here, on the dispute prevention side, one idea is that all developing countries, not only Indonesia, could unilaterally develop a tax certainty board, and this tax certainty board gives or issues rulings or positions on complex international tax issues, and where taxpayers can appropriately file their requests and get access to this particular resolution board. I'm sorry, I've exceeded my time, but last slide, I will just finalize. Next slide. Does Pillar 2 meet its desired policy objective? Probably this is a question we can debate during the panel discussion, right? So thank you for your time. Yeah.
Okay, thank you, Pak Vikram Chan, for the engaging presentation and for sharing your knowledge with us. There are several key highlights from his presentation. The first one is there will be a huge impact to the taxpayer of the implementation of the Pillar 2, starting from the collecting data, the technology, the compliance burden, and the tax return, and so on. And there is a possibility that there will be a changing behavior of the taxpayer after or post the Pillar 2 implementation, such as the business restructuring as an exit strategy, and also optimizing or tax planning with the hybrid financial instrument and so on, and re-evaluating the tax incentive. But for me, the interesting parts of the Pak Vikram Chan presentation could be found on his final slide. Pak Vikram posed provoking questions, which is, does Pillar 2 meet its desired policy objectives? So I'm sure the audience is curious about it, and we will come back to Pak Vikram Chan on the Q&A session. So move forward to Pak Timothy Smith with his presentation on the implementation of the Pillar 2 in Australia. So the stage is all yours, Pak Timothy. Please.
Good morning. I wanted to firstly say I'm very grateful and humbled when I look out over my esteemed colleagues sitting in the audience to be here to present to you today. Pillar 2 is about tax and cash collection, but you're giving up something more valuable than that, time. Time's a finite resource, you can't get back, and I thank you for that. I also want to thank you for introducing my two sons. I'm the proud father of twin boys. They're very young, introducing them to the world. And their world is very much a reflection of the ever-changing landscape of taxation. So up until a couple of months ago, their sum total of their world was Sydney, Australia. And if I can show picture. Slide. Ah, sorry, no, back. That one's different, sorry. Can you go back? No, back. One. One more, please. Maybe it's not going to work. That's okay. So, excuse me. So I had a picture of Sydney, Australia, and that was their view of the world, and that's very much how Australia's taxation system developed. We had state-based taxation, and I explained to them when I was coming into your wonderful country that Indonesia was a country, and they said to me, "Where is that in Sydney?" And I said, no, you don't understand. Indonesia is a country. And they said, so where's New South Wales? I said, that's part of Australia. And that's very much a reflection of our taxation system in 1936, when Australia first federalised its taxation system. And then when I explained that Australia was separate to Indonesia, they suddenly went global. And that is where we are today. I'm here today to present on our global taxation system. And so if we can go to the next slide, please. And the next one. And this is our implementation. And so you might say, well, that's fairly obvious, but there's detail in that slide, and there's detail that's not in that slide that's important. And so Australia have gone down the adoption route of implementing an IAR, a UTPR, and a domestic minimum tax, which we hope will be qualified, of course. Now, the way jurisdictions implement their system is a personal choice or a jurisdictional choice. You might increase your tax rate and have a wider base. You might implement a qualifying domestic IRR. You might have simply a QDMT. And so there are various options. And so that's why I've put that fairly obvious slide out there to show that what we're doing. And so I'm the compliance guy. I have someone clever come up to me and say, here's an idea, Tim, can we do it? And most of the time I say, yes, we can. Sometimes, if it's a really bad idea, I might do this. And if it's a really, really bad idea, I might do this. But at the end of the day, I'll do exactly what I did and come back and get on with it. So, next slide, please. Excuse me. So Australia announced that it was going to adopt the Pillar 2 rules, and so the ATO was allocated funding as part of that. And these are the steps that we've been down that I think are the most important in terms of a government approach to the adoption of Pillar 2. And so I've listed out the areas that I wanted to talk to you about: project management, communication strategy, support of domestic law design, consultation, admin, and client engagement. So if we go to the next slide. And so this is interesting. This is project management. And to be fair, what our team, when we were allocated funding, we pulled together various people from within the office from a diverse background. So some people with a law expertise, some people with accounting, and like myself, compliance. And so to be fair, what we're working on today is very different than what we started on. And so that's why there's some double up in terms of this slide and the previous slide. But this is where we've really, the buckets that we've landed on in terms of project management. So communication strategy, understanding the impacted population. So if you just go back, sorry. So communication strategy, which is really important. So because we found, like a lot of measures, people were interested as soon as they're announced and then went away and got on with their daily lives and forgot about it. So our process was to communicate constantly, and I'll talk about that. We wanted to understand the impacted population because that might drive some of our choices, especially in the adoption and compliance and those sorts of things. Because if we only had one affected taxpayer, it didn't make sense to have a full-blown approach. We had to support law design because often the lawyers have these great ideas, but the practical implementation sometimes don't overlap. We had to understand the systems requirements, and that's incredibly important. Multiple payments, multiple returns, that sort of thing. Understanding your clients meant understanding how you would engage with them. We had to contemplate public advice and guidance. So what areas did the taxpaying public want clarity on? And we had to determine specialist support, which is really important because often tax people, I should say, get caught up with the law but forget what a debit and credit is, what an income tax expense. And when you talk to a lawyer about a deferred tax asset, you watch the eyes in their head roll back. So, next one, thanks. So this is as I said, this is our communication strategy. Communication is key, not only internally but externally. So you'll have a large mobile workforce, and what they're working on is incredibly important for them, and they'll forget about what's coming down the pipeline. So it's important, especially our compliance teams, to keep them engaged and keep them aware and, invested. Maintain general awareness as well. We had to communicate key admin law design concepts because that's what we as administrators and what the tax-paying public were concerned about. How am I going to pay? How am I going to... Because don't forget we're dealing with M&E groups here, so they're very well resourced. So in terms of carrying out calculations and compliance function, they're probably okay. They just want to know when to lodge, when to pay, those sorts of things. And I've got stakeholders there because don't forget there are internal and external stakeholders. And so one thing we've done is we've done internal awareness sessions, but also we've done external presentations. So like today, but also the Tax Institute, we've been very, we've done a lot of presentations there. As I said, there are some of the examples. Internal awareness, communication to in-scope. Oh, actually, that's a really good one. Communication to in-scope M&Es. So website content, to the extent you can get up website content, do it. To the extent you can engage with taxpayers through website content, do it. One of the things that we found successful, especially in talking to the HMRC, was email mail-outs. Because you'll have the scenario we found of foreign inbound constituent entities who often aren't aware that they're part, believe it or not, they're not aware that they're part of a larger M&E group. And so to the extent, but you as a revenue authority will have access to data which maybe indicates that they are part of that group. And so to the extent you mail out, it starts the conversation happening. Oh, what do you mean I'm part of these rules? But I only turn over 10,000. I might turn over 100,000. Whatever it is, it's a small number. But then again, you're part of a global group. And this is this global taxation. Some of the challenges we've faced in Australia is a lack of domestic law design. And so both advisors and corporates find it hard to engage with us when it is still quite a nebula concept, despite the fact that I think that the global rules are out there, and so it gives them something tangible to latch on. They still think, okay, in terms of domestic law, where are the provisions they can read about? The complexity of the rules, they're not simple. I wouldn't say that they're difficult, but they're not simple. Tax laws interacting with accounting standards, that's a really key one that I was talking about earlier. Our law guys struggle very much so with the accounting concept. Profit before tax, or well, what do you mean it's an extraordinary item? There's been a revaluation, those sorts of things. They're used to reading black letter law. And so talking to them about what is excluded, the conversation I often have is the income tax expense in the report. The lawyer will go, yep, that's just the corporate rate applied to the PBT. I'll say, yes, but there's both a current and deferred aspect to that. And I'll say, what do you mean? It's current. We're paying it now. No, 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 no. What you don't understand is there a current bit, which is given, which results because of the permanent differences. There's a deferred bit, which is a result of timing differences between recognition in tax law and accounting, and therefore it will unwind. And so at that point, I generally lose them. We can go to the next slide, please. Okay, so we've carried out consultation, because that's part of the key as well. Keeping people informed, but also understanding what their concerns are, and they can have impact in terms of legislative law design. Now, when I say they can have impact in terms of legislative law design, the model rules are set, but there are certain administrative aspects that are important to us as administrators and compliance people that they can have input in. For example, lodgement, payments, those sorts of things. So we've carried out a three-phase approach. Phase one, we carried out with industry groups. Australia's largest taxpayers are financial institutions and mining companies, which would be unsurprising to anybody. And so we did that with those groups. They were the most affected. We then carried out phase two with mid-tier accounting firms. So not big four, they fall into that phase three. Large law firms and big four accounting firms, which in Australia is your PwC, your KPMG, those sorts of firms. That's happening now. The reason we carried it out in that way is because we had the industry groups, and their issues were going to be very different to the advisory firms. The mid-tier firms were more likely in our opinion, based on research done, to represent the foreign inbound population. Large advisory firms were more likely to represent the outbound constituent entities. And so the feedback, we're getting different buckets of feedback, which is important. So next slide, please. Some of the feedback we did get, different level of readiness in different markets, which is interesting. So if I take, I had a conversation with a very, very large bank, and they had a subsidiary in Australia. Australia, very small operation for them. Globally, they were huge. And they had done nothing. They struggled to have conversations about Pillar 2 readiness. Whereas outbound, so your outbound M&E groups, so your larger Australian taxpayers, they were probably active at the OECD level in terms of the BAG, the Business Advisory Group. They were having input at that level. They were very active at Taxpayer Institute. They were very active in sending us letters about certain consultation items. So there's a very different, which is interesting because you have an M&E group, and so these are large groups, but depending on where you sat within the group was almost determined your readiness. A lot of them came back and said they're awaiting draft legislation before they do anything, and I get that. I have sympathy for it. Although not a lot, because the model rules are out there, so you can begin to undertake readiness. If it was me, if I was a tax manager in a large corporate, first thing I would be doing is modelling how the global rules apply to us, especially the safe harbours. This last point is the one that we have had the most feedback on, the Global Information Return. It is quite large. The document itself runs to over 80 pages, but that is instructions, and I will say that the Australian corporate return runs longer in terms of instructions, so it's not too bad. But the M&E groups, the feedback that we're getting from M&E groups where they find difficulties in terms of the global information returns is large M&E groups are heavily into acquisition and disposal mode. And what that means is they will not carry out a global project in terms of systems. So your systems, your computing software systems, which your enterprise, your ERP systems in Australia may be very different to what they are in Holland or somewhere else, even New Zealand. So that is, and so because that begs the question then, what do they do now for financial reporting? And what it means generally is there is a team situated somewhere in the world, a global compliance team, which get a whole heap of reports and manually override these to form a set of consolidated financial statements. And so some of the feedback that you may receive from many groups is some pain around this because it's in addition to their current compliance load. Okay, admin considerations. So I'm on to, I talked about the globe model rules and I talked about they are generally set, but in terms of administration, there are certain things that us as compliance people can have or need to consider, actually, is probably the best word. I'll go into the background around this. So if you just go to the next slide, and this will show an article from the globe model rules. Actually, it may be from the introduction to the Globe Information Return. Slide, click. Okay, so the rules set out in Article 8.1 do not seek to harmonise tax filing and payment obligations for the Globe rules themselves, which is interesting. The operation of tax filing and payment obligation rules, including, for example, late payment interest and time limits for auditing and correcting the return, is left to the determination of each implementing jurisdiction, based on the design of that jurisdiction's existing filing and payment procedures. So the Globe model rules have done a lot of work for us, but there's a lot to come too. So just reading this, you begin to understand that the Globe Information Return is an information return as such. It will not trigger your local liabilities, or it will not trigger a lodgement or late lodgement penalty. So in Australia, for example, your failure to lodge penalty for SGE can be upwards of 750,000. So we're very keen to link our domestic provisions back to the Globe model rule. Next slide, please. Filing. So I'm going to start with filing. And I've got there, what are other countries doing? So when we were turning our mind, that project team that I talked about at the start, when we were turning our minds to what we could do in terms of an administrative complex, we looked at our existing domestic provision, but then it was interesting because this is a global tax system as such. And so we needed to give consideration of what's happening around the world. And so at the time, some of the more advanced nations were the United Kingdom, Canada, and New Zealand. And so the next few slides show what those countries are doing. And there's, I've set it out that there's an introductory slide in terms of consideration. And then there's a slide following that with what those three countries are doing. Now, of course, there are many more nations, and I could have filled it out a lot more, but they were the three that were the more advanced at the time of writing these slides. So in terms of the considerations, model rules firstly, then the administrative guidance. There's a February published administrative guidance, there's a July administrative guidance, and those are very important pieces of work because they, in a sense, help define the model rules. They're almost like legislation themselves. Additional filings, so that's that piece that I was talking about. Article 8.1 doesn't itself mandate filings as such. You will need to tap into your domestic provisions. And then when you think about it, okay, so in Australia we will have the GIR, which is then exchanged with us, or lodged, depending on whether the UPE is located in Australia. And then to trigger all our domestic provisions, so failure to lodge, those sorts of penalties and interest and those things, we will need an Australian Globe tax return. And we may end up, although this is still a policy decision and I'm a compliance guy, so I can't tell you where it's going to end up, but we may end up with a domestic minimum tax return as well. Because we're going to go down the system, I said, the government have already announced we're going down the pathway of having a domestic minimum tax, which we're hoping will be qualified, and then part of that will be potentially a domestic minimum tax return. Although the GI, I should say, the GIR does have the capability for QDMT calculation. Filing entity choice is interesting. So, in respects of the model rules allow a designated filing entity. So instead of the head company, as normally in a taxation system, mum or dad, for want of a better word, will file the tax return and the kids will go away and play. But in this case, you can have one of the kids file it, so, which may be wild in itself, right? But your system needs to be able to recognise that. So that's why I've got systems built there. So if I'm the head, but the constituent entity lodges on my behalf and registers all the liabilities, then somehow I've got to, sorry, let's leave that for a minute. If my constituent entity lodges, how do I turn off failure to lodge for the UPE? Somehow my system needs to recognise that somebody's lodged on behalf of the group. So if we go to the next slide, I'll show you what I'm talking about in terms of the United Kingdom, Canada and New Zealand. And so as you can see there, their filings they're pretty vanilla. They're not too bad. 15 months, so that's 18 months is the first period, and you'll see. And that's a concession offered by the OECD, and then it moves into the 15 months. And they are talking here both about a GIR and a domestic return. That was that piece that I was talking to you about. So if we go to the next slide, thank you. Liability and payment. This one's really important for us because we need to register the liability and we need to register the payment. And so depending on your calculations and whether you go down the path of joint and several liability or whether you have a group liability instead or you have a single, so that's that joint or several liability, you need to register at some stage that there is a liability. There's a liability that's being recognised on behalf of group entities, and that can be, in Australia we have this, the concept of tax consolidation, and that's fine. So we can have a group of, say, for argument's sake, 10, it can be 20, whatever it is, 100% wholly owned within Australia. We recognise the one liability for that group. Now the problem with the model rules is we start to introduce things like intermediate parent entities, POPs. We start to recognise different types of entities. I'll give you an example. In Australia, we have the concept of trust, being a colonial system that's imported from the UK. And trust is a fairly nebulous concept, if you like. What I'm basically saying is, I'm going to give you a whole heap of stuff. Can you hang on to it and make sure it goes okay? And then, when it goes okay, I'll get a payment out and I get taxed. Now, the globe rules don't often work like that. Instead, they'll aim to tax the trustee, which is different for us. They'll aim to tax the joint venture. In Australia, we tax the joint venture partners. So there are these different concepts that you need to consider in terms of your existing framework and how globe and how the charging mechanisms work for you. And that's where I've got their current domestic liability provision interaction. Also, your DMT liability is interesting. So I've got there the IIR liable entity, of course, and the DMT liability. DMT can be different from the IIR. IIR is set by the model rules. In some respects, the DMT liability, there is flexibility in terms of the charging mechanisms for that. The systems is something that we've struggled with at the ATO a little bit. If Tim has a liability, Tim pays $10 and it gets extinguished. But in this case, if Tim has a liability, but Grant makes a payment, then does Tim's liability get extinguished? And that's something in terms of the actual physical software systems that we need to consider. Payment. Single or multiple payments. I talked about the tax consolidation concept in Australia, and there might be 10 constituent entities as part of a group. The head entity will make payment, and that'll absorb the rest of them. But then the model rules, in some respects, can allow for, or I guess the question is, should you allow for different payments, considering it's not that tax consolidation 100% wholly owned scenario? You might have something sitting off to the edge, which is 50% owned. Well, who pays for that entity? Determine your payment timeframes. In Australia, this is interesting. Our concept for corporate tax payments is usually prepay. We love prepay. So we will have an instalment system. You can't do that under the model rules. The earliest, from memory, that you can have payment is the same time as lodgement. Now, our latest payment usually, in terms of an income tax system for SGEs, will be 21 days, 28 days maybe, in terms of a BAS payment. So an activity statement, your sales tax type of scenario. So it's not long. Some countries are allowing months, maybe years for payment. Look at your existing payment mechanisms is what I'm saying there. So in Australia, that might be, do we lump in, so we have, I just mentioned we have the BAS system, which is business activity statement. And on the business activity statement, we allow multiple payments, GST, FBT, income tax. Do we suddenly include a line for globe taxes or not? Just a point for consideration. Next slide, please. This is what some of the other countries are doing. In terms of the United Kingdom, must be paid at the end of the period of 15 months. So my question will be, does that include interest? 18 months. Tax must be paid by the date that is 20 months after the end of the fiscal year for the first fiscal year, New Zealand. So, interesting. It's a foreign concept for me. I'm used to prepayment. Next slide, please. Record keeping. Record keeping is an interesting one because it's something that we struggle with in Australia in terms of something we struggle with domestically, because often we can make requests of a domestic entity and that's not a problem. But as soon as we start to get offshore, we run into issues legally in Australia. So when I say to Australian Proprietary Limited, can I have the loan documents between you and Singapore? They'll say, no, they're held in Singapore. You'll need to make a request to the Singapore entity. And what usually happens is I'll get the details for the Singaporean entity, give them a call, and they'll say, who is this? And as soon as I say it's Tim from the tax office, that's what happens. So it's very hard to get information from offshore. And we can't compel, with Australian laws, we can't compel somebody overseas to provide that information. We do have, in section 353, that won't mean anything, sorry. Our domestic provisions do have record keeping requirements both for onshore and offshore. Now, the only penalty, the penalty provisions for onshore of not keeping and providing documentation to us are quite severe, including financial penalty, and I can't remember, maybe even a custodial sentence for the directors. I'd have to check that though, so don't quote me. But what I'm getting at is that is quite severe compared to the offshore entity. So when I say to you, when I say to the Australian entity, your offshore entity hasn't complied, the only penalty I can introduce is a penalty that cannot be produced, that information offshore cannot be produced into an Australian court in support of a position. Globe is a global tax, global calculations, and depending where you are, say you're an intermediate parent entity with taxing rights, I technically have a relationship with offshore that I need calculations for to verify onshore for the amount I'm getting. And that can be very hard to get. So consider your follow-up requests, consider your information gathering powers, those sorts of things. They are currently the administrative law design that we are having. They are the administrative law design considerations that we're having input in now as a revenue authority to the Australian Treasury. Because at the end of the day, they don't mind. They design the system, but I get stuck with it. So I need to make sure it works for me. And so if I could have the next slide, please. And this should be, yeah. I'll go to the next one because I'm just about to run out of time. Next slide, please. Considerations. Client engagement. This is a good one. In terms of your client population, so as tax administrators, we have a heap of data already. And one of the first things we did, that project team in the early days, was download what we thought was the in-scope population and start to put them into buckets. Now, it's not perfect information because it relies on stuff like CBC data, and CBC data, as we all know, is not exact. It's not perfect, but we deal with it. We can deal on publicly available financial statements. We started to work out like who and what industries were in scope and how we were going to start to deal with them. In Australia, we have, in the Australian Taxation Office, we have a variety of teams that deal with a variety of clients. We have our top 100 population. The top 100 population are the 100 largest taxpayers in Australia, and they have a client account manager who deals directly with someone there. So that interface, they have a live engagement for 12 months, every 12 months. And so that live engagement or that continuous engagement is easy to have from a Pillar 2 perspective. When we get down to, then we go to the next 1,000, we call it our top 1,000 population. And we only engage with those every 4 years. And so that's a lot harder to engage with that sort of group because people that come and do the reviews will pick it up, immerse themselves in the client, and then move on. And so they don't have that continuous dialogue, that continuous engagement. And so rather than being able to use the key account manager to be able to disseminate information to the taxpayer group, instead we're looking at potentially engaging with this group through the project team. So engaging with them directly. And then we have what's called our medium and emerging population, which is people that are usually part of a wider large M&E group, and they're coming into Australia and starting up. So startups is probably the best way to put it. And this was the group that really weren't aware of any Pillar 2 obligation. They were simply filing VASs, they were filing returns, and the returns were very simple. They had they were unsophisticated taxpayers. They were just there. And then when we went and talked to them about the Pillar 2 rules, that's when concerns started to happen for them. And so our engagement with that group is a lot different than that top 1,000 or top 100. So it's more an education piece and more a client leading piece. So in other words, presenting to that group, updating them on the calculations. Okay, you need to fill out a GIR. You need to fill out, or you may tap into your wider network. What part of the GIR do you need to fill in? And so then then I've got there, the last thing is compliance products, advice and guidance. So remember when I was talking about the trust example? Most Australian taxpayers are used to a trust or a joint venture. And so that's the sort of thing we need to put out compliance products about, just making them aware of how our natural system differs to the globe system. So next one, please. And so, in summary, I've talked to you today a little bit about our project management, our communication strategy, how we've supported our domestic law, consultation, some of the admin aspects, and client engagement. And so I've got questions there, but I think I'm out of, I think I might have upset your timing, sorry. But once again, thank you very much, and I'm happy to answer any administrative questions because at the end of the day, the administrator, M&E groups and advisors, which is probably 99% of the room, we're the one that have to do this stuff. So, thank you.
Okay, thank you, Pak Timothy Smith. Well, there are two crucial highlights from Pak Timothy's presentation. One is the Australia already has a systematic and step-by-step approach in order to implementing the Pillar 2. These are including the communication strategy, establish a dedicated team, consultation approach, and so on. So probably this can be followed by the Indonesian government too, Pak. And the second one is the administrative consideration, including the payment, liability, GIR, and also the record keeping. So I guess that is also relevant for the Indonesian taxpayers in the future, this issue. Okay, ladies and gentlemen, it's time for the highly anticipated Q&A session. So please raise your hand for any questions before you pose any inquiries. Please kindly state your name and institution, and ensure specify the panelists you wish to address for. Yeah. Okay. Any questions? Okay, the gentleman in the middle. Oke, silakan Pak.
Ya, terima kasih Pak Bono. Good afternoon, our distinguished experts. My name is Louis from DGT. This question will be addressed to Pak Vikram. Thank you in advance, Pak Vikram, for your very, as usual, enlightening and insightful presentation. My question is first, do you have any, in relation to tax incentive, do you have any research or surveys indicating how the MNEs will deal with or will respond with the, globe rules? Will the globe rules change the way they, decide how they will make their income, their investment decision? And yeah, that's the first question. And the second one is false and, to optimize or to maintain their tax avoidance scheme. You said earlier that there may be a situation that the MNE, they will split up their ownership structure in order to, to game the threshold rules. So they will not be included in the scope of globe rules as a result of that. Do you have any suggestion how to deal with this? How the administration will address this issue? Thank you.
Okay, Pak Boris, thank you for your questions. Pak Vikram, those questions are for you, Pak. Correct me if I'm wrong, ya, Pak ya. Buat Pak Vikram ya, keduanya ya. So the first question is about do you have any survey or research on the taxpayer behavior changes after on the globe rules? That's the first question, or probably you want to answer?
Well, actually, I don't have any research on what the taxpayers are going to do, but based on my own discussions with a lot of taxpayers, of in-scope taxpayers who are within the Pillar 2 rules, from a tax policy standpoint or from a tax incentive standpoint, they are basically currently actively in discussions with a lot of countries of what are countries going to do after these Pillar 2 rules are introduced in terms of tax incentives and subsidies. So I have a paper on that topic, which I'm happy to share with you. There is a paper which I co-wrote with another colleague, like a 90-page paper on Pillar 2 and its impact on tax incentives. Happy to share that with you. That's the paper I have. And the conclusion of that paper is that developing countries also need to argue for something known as a tax incentive safe harbor before the OECD, not only the developing countries, but also investment hubs, as well as large developed countries who don't have a tax credit regime in place. So most of the countries which don't have a tax credit regime in place, whether it's investment hubs, developing countries, or high-income countries, they are at a competitive disadvantage. So compared to countries such as UK, US, Canada, France currently. So this tax incentive safe harbor is something which developing countries should definitely push before the inclusive framework. It's a body where everyone has equal footing, so you should also raise your concern on tax incentives. That's the answer to the first
Yes,
question.
the first question. And the second question, correct me if I'm wrong, Pak. Do you have any statistics on the taxpayers who will optimize their the loopholes in the Pillar 2, right, Pak?
No, it's not on taxpayers. I don't have a survey or I don't have any research that's done. It's just common sense that some of them are doing it. Now, some of the restructurings that would take place before Pillar 2, they are genuine restructurings. Don't get me wrong, they are very genuine restructurings which take place. So whenever there's a proper restructuring with a lot of commercial purpose to it, then it should not really be a problem. But just a restructuring that is done to take advantage or to ensure that the Pillar 2 rules do not apply, probably countries can tackle this through a general anti-abuse rule, which is there in the national tax law. Indonesia has one. A lot of common law countries and civil law countries have a general anti-abuse rule. So that could perhaps be used, and typically these rules apply when the main purpose of the transaction is to get a tax advantage. But detection of these schemes will be a challenge. So while it sounds very nice that you can apply a GAR, but detection can be a challenge. Probably, this is something which policymakers can consider is they can have a separate line on the Globe Information Return. Did your M&E group restructure before entering into the Pillar 2 regime? For example, that's, if they say yes, they tick the box on that, and probably that's a red flag. Probably, yeah. So that could be one way to detect a scheme. I don't know if you have any other thoughts on that. Please.
Yes, there is a section in the Globe Information Return on restructures, so which is very, very important, and the model rules do allow for restructures coming into Globe, certain restructures, correct me if I'm wrong. But yeah, so what we're turning our mind to, you're right. So currently we're considering our current provisions in Part 4A, so that's our general anti-avoidance, and whether to apply it to restructures coming into Globe. I think your point about detection is a really good one, but that's not unusual. We face that every day. Yeah, and I think, I think that's probably, because it's a global tax system, the more implementing nations there are, the hope is that there will be a free exchange of information, and hopefully we'll be able to break down things like this. Like the taxation system itself has evolved. We have our hybrid mismatch rules in Australia, which will pick up that related party financing issue. So the more nimble our tax system becomes, hopefully it will capture these scenarios.
Thank you, Pak Tim, Pak Vikram. Pak Boris, do you have any follow-up questions? Okay. Any questions? Okay. Gentleman, Pak Bobby, yeah, and then the gentleman in the middle.
Thank you. Thank you for the opportunity, Pak Bono. I have two questions, one for Vikram, one for Timothy. So the question for Vikram is, referring myself to the statement that is made by Professor Brian Arnold regarding the complexity of the regulation, complexity in implementing the rules, and the hassles in doing that. And then also there is a remark that, well, the tax consulting will get richer. Well, I don't mind to get richer, but still, my question is back to the philosophical question that you haven't answered in your last slide. I think it's very important to answer from your opinion and experience, from your many articles and journals. Do you think the Pillar 2, as it stands right now, fulfilled the desired policy objective? That's the question. And before I forget, may I ask the second question first? Okay, the second question for Timothy is, regardless what Vikram like to offer about the opinion of the policy rationale, at the end of the day, Australia has taken a step to take Pillar 2 into realities, right? There is a step to do that. My question is, honestly speaking, is Australia taking this this policy because Australia thinks that this policy actually fulfills its desired policy objective, or because there is no other choice other than joining this because everybody will join this rules and regime. Thank you.
So,
Okay, Vikram, first question.
Thank you for your question. Very nice question. So, personally, I feel that, okay, just a few steps back. The object and purpose of the Pillar 2 rules was to somehow stop multinationals from profit shifting and somehow put a brake towards race to the bottom tax competition. But when you do a detailed technical analysis of the rules, this policy objective is not met. And just a simple example is the qualified refundable tax credits. So in the US, it's called the marketable transferable tax credits, which these regimes are blessed by the Pillar 2 project. So, depending on the government responses also for Pillar 2, multinationals can still go down well below 15% cash tax payment-wise, but at the same time, from Pillar 2 point of view, they will be above 15%. So at the end of the day, the government will not collect any cash, but still the multinational will be above 15%. So the government doesn't get the appropriate cash, by topping it up to 15%. So that's not really happening. But this also depends a lot on how governments respond to Pillar 2 rules. If the governments of many countries adopt these QRTCs or marketable transferable tax credits or other incentives which are blessed by the project, you may just question, okay, what's happening here? The government's not collecting the appropriate cash. That's on the cash collection mechanism. But on the other hand, where is all this going to lead to? So, of course, it's a complex thing, but within 2 years, once you read the commentary, the rules, everything you can understand this stuff. It's not rocket science at the end of the day. It's pretty much understandable, except deferred taxes. So that's the most complicated part of the rules, but it's understandable. But where is this going to lead to? 4 years, 5 years down the line. So once the Globe Information returns are filed, once the QDMTT returns are filed, this is just depending on the tax audit approach that is adopted by the local tax administration. This has the possibility to create a global mess unless appropriate dispute prevention and resolution rules are developed. When I say appropriate, I personally think they need to come through a treaty route, through a multilateral route, whether it's a multilateral convention or a bilateral treaty route, which currently the project does not have. Otherwise, if a multinational is left at the mercy of each and every tax administration, and every tax administration has aggressive tax audits, a lot of developing country tax administrations are known to be pretty aggressive. From a tax certainty standpoint, so multinationals want tax certainty, and this project does not deliver so far on the tax certainty aspect. So this can create a lot of global issues and mess, I would say.
Okay, Pak Timothy.
So that was a really good question, and my inclination with any good question is to do this. No, I'm kidding. So I'm going to have to answer that personally rather than on behalf of the Australian government. So, because as I mentioned up front, I'm the administrator, so what I think doesn't matter most of the time, unfortunately, and I'm not being flippant. That's just how it is. But look, if you're asking Tim Smith in a personal capacity, then Australia has a high corporate tax rate of 30%. So will we see, do we currently have leakage in terms of tax revenue? There is some leakage, but is Globe the solution for us? I think it's a good idea, don't get me wrong, but we've probably gone down the adoption system because that's what everyone else is doing, and if it's cool, why not? So it's kind of like, if everyone else is doing it, then it kind of suggests that maybe it's the right thing to do. Like if everyone jumps off a bridge, nobody does that, right? So because it's a bad idea. So if a lot of people do something, then maybe it's not the worst idea in the world. So. Does that answer? I'm sorry, I can only answer as me.
Maybe Vikram wants to add something.
Well, actually, what you said, it's the Me Too strategy. So why not, if everybody else is doing, why not I do it? Well, probably in a Pillar 2 context, it makes sense, that you follow what has been stuck to you by, other organizations. But in a Pillar 1 sense, also, you can just say, okay, fine, Pillar 1 amount A will not go through. Sorry, I'm just changing topics from Pillar 2 to Pillar 1. Pillar 1 amount A, US doesn't sign it, does not go through. Well, every country is adopting a DST, so we should also adopt a DST. Now, whether adopting a DST is a good policy choice, I personally think it's a bad idea adopting a DST. Because in the end, you're killing a multinational by adopting a DST, a low margin tech multinational. DSTs are a bad idea. So I would just say that Me Too strategy, maybe it works in a Pillar 2 context, but not in a Pillar 1 context, which amount A context, which amount A fails, then you adopt DSTs. DST is just a bad policy choice. That's my personal opinion.
Okay, thank you, Pak Vikram. Bu Melinda, it seems that you want to comment on this.
Yeah, I think it's a really interesting question, actually. And I obviously, I can't speak on behalf of any particular country because I'm here as a member of the OECD Secretariat. But I did want to relay something that we have heard from New Zealand quite recently, which I found very, very interesting. So New Zealand have taken the approach that they will adopt an IIR, but they are choosing not to adopt a QDMTT. And I did find that really interesting. And we asked New Zealand why they have taken this policy approach. And again, I don't want to put words in New Zealand's mouth, so please don't sort of quote me on this. But what New Zealand explained was that in terms of a QDMTT, if they adopt that, they don't think there is much low tax income in New Zealand because they have a relatively high corporate tax rate. They don't have significant numbers of tax incentives, which would potentially reduce that tax rate and create low tax income in New Zealand. So they don't think, first of all, that there's a lot of money to be collected. There won't be much, if any, top-up tax to be collected in respect of low tax income in New Zealand. But they've said that if they put a QDMTT in the New Zealand statute, that puts a certain responsibility on the Inland Revenue of New Zealand to monitor compliance with that statute. So they're creating an administrative and compliance burden where they don't think there is much top-up tax to be collected in that particular circumstance. So you can look at a QDMTT, and I had previously certainly had the opinion that, aside from potentially the additional complexity, there is no harm in having a QDMTT. And I think for most countries that is still true. But certainly it was quite eye-opening to me to hear New Zealand's perspective that they have done the analysis. They don't think that there is much, if any, top-up tax to be collected in respect of New Zealand low tax income. And therefore, they've taken the decision that at least for the time being, they don't think it's worthwhile them incorporating QDMTT into their statute, notwithstanding the fact that they are going to apply the globe rules more generally. So I just thought that was an interesting perspective as well.
Okay, thank you, Bu Melinda. Pak Bobby, do you have any further questions? Okay. Well, ladies and gentlemen, unfortunately, we've reached the end of the session one. So, and despite of our engaging discussion, it's time for lunch, I think. So, okay. So, let us give a big applause to all the panelists. Okay, Bu Melinda, Pak Vikram, and Pak Timothy. And also, I would like to thank you for the Fiscal Policy Agency for setting up this International Tax Forum to ensure the meaningful participation on the Pillar 2 implementation in Indonesia. Okay, thank you very much, and wassalamualaikum warahmatullahi wabarakatuh.
Mr. Bawono, Bapak Bawono, and all of the speakers, can you please remain on stage for the photo session? Please stand up. Okay, ladies and gentlemen, that was our discussion on session 1, Pillar 2 implementation and update. Please once again give a round of applause to our panelists and moderator. Thank you. Distinguished participants, ladies and gentlemen, to improve our capacities and the quality of our future events, we would like to invite you to complete the evaluation survey of the ITF 2023 via the link provided on the screen, or probably later on. Please click the link to access the survey anytime before the event is over or on Thursday, 26th of October. We encourage you to fill in the survey, as participants who fill the survey will be eligible for a certificate of attendance. We would love to hear from you. Now, ladies and gentlemen, before we continue to our next session today, I invite you to the most anticipated lunch break. We will have a lunch break provided at Don Bu restaurant located next to the lobby. Also, for those of you who need to perform prayer, the musola or prayer room is on the second floor of this building. All right, for the next session, we will have an interesting session 2, which will be a focus group discussion on the implementation of Pillar 2 in Indonesia, where we will seek a public input from the stakeholders. The session will be in Bahasa Indonesia and will be started at 2 p.m. sharp. Regrettably, session 2 will be a closed session, so there will be no live streaming from this point forward. So for our virtual guests, thank you for joining us today, and we'll see you tomorrow. Thank you once again. I'm Ernie Zaomi, and see you later. Thank you.